lifting in this area too. With this, I would stop. Let me once again thank all of you for making the effort, for coming to our premises, and I am now looking forward to a very insightful discussion on these panels. But first and foremost, I'm looking forward to the keynote speech of Commissioner Merritt Mcginnis. I hope my staff will apologize.
Your Irish pronunciation, I think, is excellent, but I hear that we have a sound problem. Okay. So we're going to take a brief technical break in order to fix our sound and then get right back to where we left off.
Okay.
Sound is great in this room, but clearly I think it's not going out on the stream. Yeah. Virtual life.
Virtual life. As we said before, it's odd. Can you hear me? Can you see me?
Yes.
Put on your mic.
It's back?
It's back?
Okay.
Can I just test whether everyone can hear me now? In this room, I think everyone could hear me even without a mic, but let's try.
Elke, 1 second. Susan, need Elke to give her remarks again?
No.
Susan, do you need Elke to give her remarks again? Okay.
Then I do now a very short version of them. I think we are mightily optimistic now compared to last year. We have delivered, the banks have delivered, but there is more to do, and this means our 22-23 work program to make sure that at the end of 23 we are really delivering to the milestone of full resolvability for banks under our remit by then. And one point which I always take very close to my heart, just to repeat it once more, delivering on setting up, building up the full MREL. It should have never been easier than today. The markets are wide open, so banks should get their act together and not hope for the markets being even wider open sometime in the future. So with that, I think what we are left with, beside all the heavy lifting we have to do, is really to continue to deliver, to finalize the banking union, and, that was my last comment, not to forget that there is a complementary project called Capital Markets Union, which we all need to work on. And with that, that was my last comment before we had the technical problem. Thank you for all of you, and I am very much looking forward now to listening to all of you to get the answers to all the remaining questions, because I think the panels are very well set for this. And with that, I would now introduce our first speaker, Commissioner Merritt Mcginnis. And I think we talked about it before. You honestly don't need any introduction. You are now our commissioner for a year's time, and you are widely known by everyone, and we have high expectations in you delivering the remaining bits and pieces together with Council. Thank you, and I leave the floor to you.
Thank you, Derek. Thank you.
Well, let me unmask first, but it's just to prove that in this room, you can all hear me both in the room and outside the room. Just to say, Elke, thank you for your warm welcome and your message, always clear and to the point. But I think it's really good to mark the optimism that you spoke of in your few words. I think we're all more optimistic. The fact that we are physically present means that our attention to the pandemic has worked, but we still have work to do. And perhaps that's also the metaphor for banking union and capital markets union. So I think the title of this, or the theme of today, is really important. You said we still have work to do on banking union, and I've put that in big markings on my speech. So this is the clear message, and we can do it. So let me go some of these points. I think really to mark why we know and why we made a commitment to banking union, we have to go back to the global financial crisis and the euro debt crisis, because we took a decision then to set up the banking union. And the purpose was to strengthen the euro and the economic and monetary union. And so far we have put in place the single supervisory mechanism and the single resolution mechanism. And of course, that set up the single resolution board. The SRB and authorities around the European Union have shown great perseverance in implementing all of the reforms so far, as alluded to by Elke. Banks and other financial institutions recognise the need for change too, and have worked to comply with new requirements and play their part in funding the crisis management safety nets so that taxpayers would not pay for failing banks. These first two pillars of the banking union have made our banks more resilient. Again, a very strong point going into this particular economic shock during the time of pandemic. And indeed, I think we should compliment our banks for helping to deliver many of the support measures introduced by governments to the rest of the economy. But to maintain financial stability and maintain our resilience in a future crisis, we must complete our work on banking union. But maybe to take a step back from technical issues and terminology and to talk perhaps about why a full banking union is worth having. Last week I spoke in the European Parliament of the need to communicate more clearly to Europeans what banking union is and why we all need it. And I want to reiterate that point here today. Because I think if we become mired in overly technical and impenetrable discussions, we lose the attention of those who banking union is meant to benefit most, European citizens and European businesses. And that makes it then easier to avoid the need for compromise in getting the job done. So sometimes the confusion over terminology and approach masks the benefits that are hidden underneath. So I want to emphasise here today that, first of all, banking union is vital to protect European banking sector itself from a future crisis and to safeguard financial stability. The banking sector has remained stable during this crisis, but if we do not complete the banking union, we have no guarantees of that stability in the future. So we need to live up to our promises as policymakers to do all we can to prevent another banking crisis, with all the impact that would have on lives, livelihoods and taxpayers' money. The pandemic was and still is an exceptional crisis. It's not the usual financial bubble or economic boom and bust. Across the globe, a virus brought everything to a sudden halt, and our public authorities rightly took exceptional measures to deal with this very exceptional crisis, providing huge supports to those directly affected, and of course rightly so, helping to keep businesses afloat during lockdowns, and also households benefited from unemployment support and loan moratoriums. And that action directly supports banks' asset quality. But we can't assume that that level of public support we've seen during this pandemic would be available in a more typical financial crisis. And I think that's what we need to be prepared for. So we need to make sure industry finance safety nets are effective across the Union in times of crisis. That means completing the banking union. Beyond preparing for a crisis and maintaining financial stability, a fully fledged banking union is essential for the future of the European Union's banking sector. We want strong EU banks that can provide competitive and innovative services for people and businesses across the European Union. And of course, the banking sector, not just in Europe, but globally, is facing a period of major change. Digitalisation is moving fast, causing deep structural change. The potential benefits of this are huge, because digitalisation can boost innovation, increase efficiency, and drive down costs. But for banks, there are challenges as well. Fintech companies are entering the market. They are gaining market share by using big data and offering services that are attractive and easy for customers to use. To keep up in this digital world, our banks will have to adjust their business models and operations, because business as usual will not be an option. And all of this change is happening against a backdrop of an ageing society and high levels of debt. So we must make sure we have a strong regulatory framework so that we can accommodate this change and not be overwhelmed by it. And that means, again, completing banking union. You will hear that sentence several times in my speech. We need a system that fosters consolidation where scale matters, including across borders. Without mutualised safety nets, we will not reach the level of trust required between member states to allow banks to operate fully across national borders. And we need to ensure that a bank that fails to adopt can exit the market in an orderly way without threatening financial stability. Without a fully effective, complete crisis management framework, market exits will not happen in a managed and timely manner. And just a final thought on market integration. Given the economies of scale that are necessary for the digital change, as well as competitive pressure from fintechs and larger overseas banks, smaller European banks need to grow. The market is pushing for more integration through the central management of resources like capital and liquidity and cross-border consolidation. And I believe regulation should facilitate this process. The Commission will also make sure that any changes include safeguards for host countries. We want to ensure that resources are available when needed and that financial stability is maintained. Completing both the Banking Union and Capital Markets Union will foster market integration, consolidation, especially cross-border and competition. And thank you, Alka, for mentioning the two sides of our financial coin, Banking Union and Capital Markets Union. So the burning question on top of my page is, how do we complete the Banking Union? The Commission fully supports the Eurogroup's efforts to draw up an ambitious work plan for the Banking Union, because it's vital that we keep the conversation going with the aim of reaching agreement. In terms of our action, the ambitions remain very high. On the second pillar of the Banking Union, we want to strengthen the crisis management and deposit insurance framework. If a bank fails, taxpayers should not end up footing the bill. If we need external funding for the orderly resolution of banks, it should come from industry-funded safety nets. So the review of the crisis management and deposit insurance framework is timely and important. And I would like to thank the SRB for their contribution to our consultation. It is encouraging to note that the views of the institutions involved in crisis management, the ECB, the SRB and the Commission, are very much aligned on the right way forward. This review can help us achieve consistent and proportionate solutions and to avoid incentives to use different solutions at the national level. As well as strengthening our existing architecture, we need to build the third pillar of the Banking Union, the European Deposit Insurance Scheme, because Banking Union will only be complete once the European Deposit Insurance Scheme is in place. EDIS can make national schemes less vulnerable to large local shocks, and it means that if a bank fails, we protect financial stability and consumer confidence, and they go hand in hand. It also ensures banks can keep providing finance to businesses and supporting the growth of our economy while protecting EU taxpayers. As a first step, we are discussing the possibility of a hybrid model for EDIS, coexistence of national deposit guarantee schemes with a common central fund. To start with, EDIS would provide liquidity to national deposit guarantee schemes in need, enhancing depositor confidence and making banks more robust in a crisis. We would design the hybrid model so that it can evolve over time. But at the Commission, we remain very convinced that a more ambitious EDIS setup involving loss mutualisation is needed in the steady state of the Banking Union. We also need a credible and robust mechanism to provide sufficient liquidity in resolution. As in other jurisdictions, the Banking Union needs a public sector backstop liquidity mechanism to safeguard against large shocks. I know that this last point is also a priority for the SRB as we head into next year. Right now, and I regret to say this, the word that comes up for many when talking about Banking Union is frustration. And that goes for industry, I'd say everyone in this room, consumers who hear about it and wonder what's happening. And I have to say it also identifies very clearly the mood on the policy-making side. The costs of a partial banking union are high, and I think if we think about that, we will step up our efforts. The banking sector wants the full benefits that a complete banking union has to offer in terms of market integration and a supportive regulatory framework. The sector absolutely needs this. Consumer associations rightly want us to reach a point where citizens of the EU trust the banking system fully and are better protected against future crises. Elke, you said, and thank you for reminding me, that I've marked 1 year in office. I think I've aged 10, but I've marked 1 year just yesterday in my role as Commissioner for Financial Services. But it's actually been a huge honour, and I am very much really happy to be engaged in this important sector. But as a policymaker new to this area, it's been a bit remarkable that I could have come in almost at any point over the last 5 years and had the exact same discussions and debates. We have barely moved forward, and it is simply not good enough. And if you remember that line from my speech, I hope you will take it with you. Because I think if we've learned anything over the last 2 years, it is to expect the very unexpected. We have to be ready for the next crisis, be it health, environmental, energy, cyber, or indeed financial. So I hope we will be strategic on banking union. We need to agree on a comprehensive plan with political consensus. I think that is our first big step. And will set us up to make progress on the individual pieces that I've just alluded to. Because I think if we are serious about completing the banking union, and I believe we all are, I think we all act in very good faith on this, then we don't have any more time to waste to achieve it. However, if we all stick to our positions, our national concerns, we will fail to provide the frame for our banking system, a system that is changing fast and needs stability. So at the very outset of my speech, I recalled the decision after the global financial crisis to set up banking union, to strengthen the euro and the economic and monetary union. That objective should not be forgotten as we continue our collective efforts to move this process forward. I mentioned the word frustration, but I also would mention determination and doggedness to get this job done. As I'm leading in this area, I hope you've realised in the last 12 months, I come with that badge and I intend to complete the process before I leave office with your help, with your support and with your determination. Thank you.
Commissioner, thank you very much for that very clear and emphatic message. We got a brief glimpse of our graphic artist's recording, and she's put frustration right at the center of her sketch, but I'm sure she'll add determination and doggedness as well. And we will definitely be taking your impulses with us into our discussions. We're going to be up on a number of the topics the Commissioner has just mentioned, ranging from liquidity and resolution to a hybrid for EDIS, and of course that CMDI review. So we will certainly value your input for those discussions. We continue now with a perspective from one of the Eurozone's leading globally active banks. It's a great pleasure to hand over to the CEO of Deutsche Bank, Christian Sewing, who is with us here live in Brussels.
Well, good morning, ladies and gentlemen, and thank you very much, Elke in particular, for inviting me today for what I'm sure is a very important forum. We welcome the important role of the SRB and the SRB has played in ensuring the preparedness of European banks in case a crisis strikes. And of course, you will allow me to say that we all want to make sure resolution plans will never have to be put in place. But the now mature resolution framework, which has been established, has allowed us to improve the quality of our planning and helps to address any vulnerabilities which may occur in our business. And I'm really delighted that Commissioner Mcginnis has opened the debate so passionately with a call to complete the banking union, which is something which we at Deutsche Bank wholeheartedly agree to, endorse and believe is a prerequisite for Europe's future success, for Europe's future competitive standing. And that, of course, together with the Capital Markets Union. We also support the EU strategic autonomy and the European Commission's efforts to strengthen our financial service sector. At Deutsche Bank, we want to be in this regard a thought leader at the center of this debate, and that includes a constructive dialogue about the current regulatory framework. Strengthening Europe's financial market infrastructure is as much in the interest of market participants as it is in the interest of regulatory authorities. As we look towards a post-pandemic recovery, Banks clearly want to stay and remain part of the solution for Europe, its economy, and most importantly, its societies we are operating in. To play their part, banks in Europe must refocus their business models. We must further strengthen our balance sheets while bolstering our systems and infrastructure. And I can tell you, we have come a long way in this regard. Yes, there is still a lot to address, but European banks have done a lot of good homework and produced good results. And at the same time, we also feel that there is a role for policymakers. And that is because currently European banks do not operate in an efficient single market for financial services. And this impacts our competitiveness both at home but also globally. And this will ultimately undermine the effort to have a strategic autonomy in the financing of the European economy. This also has an impact on our resilience and that of the overall market. And as Commissioner Mcginnis said, there are still outstanding reforms that can deliver a truly single market for financial services in Europe. These reforms reflect a political consensus for the ultimate objective. The same is not true for the intermediate steps. While the political debate is ongoing for the bigger projects, we should also make sure we keep sight of other regulatory reforms at the doorstep. I will briefly highlight 4 issues where ongoing regulatory and supervisory support would have a material impact on building a European banking sector that is more sustainable, profitable, open and competitive, but no less stable. Number 1, Basel implementation. As Europe is still heavily dependent on bank funding, the impact of the final Basel III framework will not just be felt by banks, but most importantly, by our clients. Originally, European finance ministers had issued a mandate for no significant increase in capital demand. We now hear that according to EBA estimates, the Basel package would increase capital requirements for European banks by an average of up to 19%, which would impact lending capacity significantly. With US regulators indicating a capital almost approach for US banks, the European implementation risks further weakening the competitive position of European banks. And that would clearly undermine the strategic autonomy agenda. Implementation should therefore adhere to the scope of the Basel reform, but the letters can and should be tailored to fix. And yes, I am fully aware that with the adjustments not to lose credibility, clearly. But we are strong and self-confident enough to make the necessary adjustments that reflect European characteristics, like, for instance, family-owned corporates in Germany, which simply have no and will not have an external. Number 2, the Single Resolution Fund now impedes EU banks' ability to finance the transformation of our economies and to invest in their own future digital strategies. The SRF keeps growing beyond the initial target size. And what is important, not because of additional risks in the banking sector, but because the methodology which is chosen links the fund's volumes to deposits which have been inflated in an unusual way during the pandemic. By now, the fund has gathered bank contributions of more than 50 billion euros, and these funds sit idle rather than support the economic recovery. This limits lending capacity and investments of EU banks, and it also places them at another competitive disadvantage. We all know our USPs do not have to contribute to a national resolution scheme. Therefore, we think it's now the right time to consider at least some adjustments. As the SRF has now reached its initial target size, the remaining contributions in 22 and 23, if made at all, could be directed to increase new corporate lending under EU guidance in a direct lending fund. Irrevocable payment commitments are an additional way to help banks to absorb the impact of ex-ante contributions to deposit guarantee schemes and resolution funds. In fact, That was the original purpose of IPCs when introduced years ago. But since then, banks had to deduct them from our capital stacks. It would help tremendously if banks could apply IPCs as they were originally intended, and if the SRF would make full use of the flexibility provided by law and allow 30% of contributions to be in the form of IPCs. Again, this set would have one goal: free up capacity for banks to direct towards lending. We stand ready to collaborate with the SRB and the Commission to discuss specific lending structures and make IPCs more risk sensitive in a way that ensures the maximum benefit is passed on to the European economy. Number 3, UK central counterparty. Without an extension of equivalence, clearing will remain in the UK and European banks will lose market share, leading in the end to less financial stability. The Commission's plan to reduce European dealers' exposure to UK CCPs, specifically the London Clearing House, and develop further capacity in the EU. However, the fact remains that clearing decisions are ultimately driven by clients based on efficiency and value. And there is no current European alternative that gives our clients a reason to switch voluntarily. That means that with an equivalence arrangement allowing EU banks to remain members of the London Clearing House after March 2022, this business will stay in London and will shift to our UK and US peers. No clearing will have moved to the continent, and the shift towards non-EU regulated banks will have contributed to increased financial instability. The current timeline is too short to achieve an efficient, resilient onshore euro clearing market. We propose extending equivalence and then driving voluntary relocation by working on creating a competitive EU CCP offering. Number 4, I will repeat because of its importance and to expand on what Commissioner Mcginnis so rightly said. We must complete the banking union and the capital markets union. A full banking union would strengthen individual banks and enable much needed consolidation, another requirement for keeping European banks globally competitive. Europe must also urgently develop its capital market and use it more effectively to finance the post-COVID recovery and, even more importantly, its transformation of its economy. The sums needed are vast, and the EU Green Deal, for instance, in my view, will not succeed without a stronger European capital markets complemented by appropriate financial sector expertise. Policymakers should support the expansion of the securitization market on the basis of the strict post-2008 crisis framework that allows more confidence in these products. Ladies and gentlemen, as one of Europe's largest banks, Deutsche Bank takes our responsibility to further strengthening the resilience of the EU financial sector very seriously. It is in this spirit that I say the current regulatory framework is not fully attuned to the needs of the economy and the EU strategic agenda. The question is whether Europe will have any global competitive banks a few years from now, and whether we can finance the once-in-a-generation transformation that is already underway. Especially in a time of growing geopolitical tension, it would be a strategic mistake to put ourselves in a position where we are heavily reliant on non-European banks. Deutsche Bank believes there are concrete actions available to advance the EU agenda on strategic autonomy and support European banks. We are very much looking forward to continuing work with policymakers on how to ensure a smooth regulatory implementation that does not impede our capacity to finance the economy and ensure our competitiveness also in the next decade. Thank you very much.
Christian Sewing, thank you very much for that very clear message. And you, in fact, yourself will continue work today. You're going to be joining our first panel, so may I ask you to kindly take your seat here. And ladies and gentlemen, as Elke König reminded us earlier, the corona may have put many activities elsewhere on hold, but it certainly did not work here, and it impede the ongoing development of the resolution framework. Last May, the SRB published its blueprint for the management and deposit insurance framework review that the Commissioner also just mentioned. Our first panel brings together leading stakeholders to assess where the resolution framework stands today and also to outline priorities for its future evolution, which is why evolution, not revolution, is the subtitle of session 1. And please send us your questions, ladies and gentlemen, via Twitter or Slido, and I hope to bring a couple later on in our discussion. It's now my pleasure to introduce our very eminent, and I will ask them to join me, those who are live here in the room, as I read off their names one by one, and I will keep the introductions here short in the interest of time. And I begin with our remote participant. Joining us online is Harald Weicklein. He's Director General for Economic Policy, Financial Markets and Customs in the Austrian Ministry of Finance. Wonderful to have you with us, Harald Weicklein. Paula Conte is with us here live. She is the Spanish Executive Resolution Authority's Chair, the FROB. And if you would come take this seat here, Paula, welcome. A pleasure to meet you. Also with us is our regular John Varrigan, Sean, Director General of Financial Stability, Financial Services and Capital Market at the European Commission. A very warm welcome to you. And finally, it's a pleasure to greet Jan Render de Carpentier, Vice Chair of the Single Resolution Board. And if you'll just take that seat there, that we will get started straight away. And not seeing Harald Weicklein yet. I hope that he is with us. May I get confirmation on that? There he is. Hello, welcome. Great to see you. And I'd like to begin with, in fact, Mr. Weicklein, Austria has a variety of big banks that are, of course, under the remit of the SRB, and also banks that are dealt with by the national authority. What would be the merits of a common liquidation regime for small and medium-sized banks, and how could that be integrated into the ongoing crisis management and deposit insurance review, henceforth to be known as Cmdi? If you would, please let us know that.
Thank you very much. That's actually a very good question, and touch on something that I might come back later on, namely where we're going at the European level. First of all, the benefits of a common liquidation regime would be economic, because it's quite clear that, and that comes from experience in the US, that ordinary insolvency procedures, which were drawn up with corporations in mind, don't really work that well for banks. And the reason for that is a bank's liabilities are much more volatile than corporations' liability. And that is actually why in the US there are two systems for insolvencies or liquidation, whatever you may call it. One for corporations and one for banks, because banks, they recognize that banks are very different animals where you need different procedures. And I think this is the model that we should follow in Austria, but in Europe in general, because it makes sense. And the benefit for us in Austria would be, of course, that we get to reap the benefits of the single market in financial services, which, as has been pointed out correctly, doesn't exist at the moment, or only to a certain extent. But I also have to say that's easier said than done, because this is not how it is perceived by parts of the financial sector in Austria, particularly Sparkassen. They have lots of reservations about EDIS, because many of them just operate at a very local level. They don't see the EU as a single market because it's not relevant for them. They don't even care much about regulation at the European level, but they are driven by the fear that they have to pay contributions for a fund that will in the end be used to bail out banks in other countries, in particular Italy. So that's more trust issue than an issue of real arguments. It's a very politicized debate, and that makes it so much more difficult to resolve. In order to make progress there, we have to give those stakeholders the confidence that the European system is actually trustworthy, gives the right incentives, and will not be used for disguised bailouts of problem banks in other countries.
Thank you. Thank you very much. And let me go to Paola Conte, because your organization was the first national resolution authority to implement a bank resolution decision under the current framework. So maybe you can tell us a little bit about the lessons that were learned during that process and how they should feed into the review of the current CMDI framework.
Yes, Melinda, thank you. And good morning to everyone. It's quite a pleasure, and thank you to the SRB invitation. It's a pleasure to be back in Brussels and in such good company of living human beings rather than virtual ones. But going back to the question, Melinda, yes, indeed, FROB was the NRA, the National Resolution Authority, that participated with the SRB in the resolution of Popular and put the resolution framework to the test for the first time in 2017. And joining the cheerfulness and optimism of Elke this morning, I think that the good news for everyone is that it passed, and it did so quite satisfactorily. And I think one of the main lessons learned is that the design of the framework, although there are certainly certain aspects that have to be reviewed, and I will go into them in a second, is that it achieved the objectives that it is set out to meet, which are protecting financial stability, minimizing the impact on the economy, and avoiding the use of taxpayers' money. And I think the practical experience of Banco brought to light the importance of very close coordination between all authorities involved from very early stage, and for communication and cooperation to flow at the authority level. And also it showed the importance of previous planning and preparation. And in that regard, completing resolution plans, performing dry runs, working on guidance and any aspects on related to expectations for banks, and ensuring monitoring the progress and resolvability is absolutely crucial. And I think remarkable progress has been done over the past years, and is a very large part of what is the core of the framework that we have designed and the work that's being done. And I think in that regard, we can be very satisfied and very proud of what is being achieved. But that being said, and after this initial take, it's true that Popular also brought to light certain other issues that have to be reviewed and can be taken into account in the current review that the Commission is undertaking. And in particular, I would highlight two. The first one is liquidity and resolution, which I think is also one of the areas where, as the Commissioner was saying, there's a lot of frustration, because it's definitely not a lesson learned that is new. But we have yet to find and agree on a solution that would ensure that resolved entities have access to liquidity the day after resolution. And the other important lesson would be the virtues of the sale of business strategy. And indeed, for Banco Popular, the sale of the entity was the best solution, and perhaps even the only one at that time, to ensure liquidity, to restore confidence, and to prevent any sort of systemic contagion. And in that regard, it would be important for the review of the crisis management framework to take this into account and to introduce the necessary changes to facilitate the implementation of the sale of business. And I'm not referring here in particular to the work in the planning and the preparation phase, which is already is ongoing, and there's excellent work being done by authorities with entities on separability, on developing the systems to provide timely and updated information. But I'm referring more particularly to certain legal changes that would, for instance, facilitate that there are sources of funding that make it more probable to find a buyer, and also to maximize price, and in particular to make use, for instance, of tools such as guarantees or asset protection schemes that proved very useful in the Spanish crisis. And I think in that regard, it would be important in the crisis management framework review to take into consideration legal changes that would, for instance, revisit the conditions to access a single resolution fund to facilitate these sales, or perhaps more promisingly, to also expand the role that deposit guarantee schemes can play in a resolution scenario, and therefore that there's more probable to use single deposit guarantee scheme funds to be able to implement resolution tools successfully. And I think that would definitely be something important to take into account, that hopefully the Commission will take note.
Thank you very much. I will go straight away to Sean Berrigan. The public consultation that was part of the CMDI framework review did in fact end about 6 months ago, a little less than 6 months ago. So maybe you could share your perspective on key topics that the numerous contributors did bring into the mix.
Well, thank you very much, and it's nice to be back.
It's nice to have you.
Thank you. Not surprisingly, what came out of the consultation echoes quite a few things that Paula has mentioned. I mean, there was general support for the framework. That's the first thing to say. So this title of evolution, not revolution, is apt because that's not what came out of the consultation. There was also a lot of support for the basic objectives of the framework, which is to preserve financial stability and minimize the impact on taxpayers. But there was clearly a concern through all the end that the framework is perhaps not usable enough. I don't say used enough because that could be a historical accident, but it's just not usable enough. This was seen as adequate, so that was good news for us. We had all in the legislation, but the message coming through that we need to use the tools more effectively, more consistently across the framework. In more specific terms, what came out was, of course, we need to use the public interest assessment more, I think expansively was the word that comes out. Indeed, there is a perception that it has been used a little bit restrictively in the past. There was a bit of tension around the funding question between those who felt there was a need to apply the rules as they're in the legislation rigorously, and there was no question about that. But on the other side, there was a view that there was also a need to make access to funding more flexible or more proportionate, let's say, across the full range of banks. More generally then, there was a need for consistency based on this extension of PIA and the funding, a need for consistency between what we see as the resolution framework here, which is the one that's operated by the SRB and the SRM, and insolvency frameworks at national level, but also more consistency between the use of national insolvency frameworks across member states. So this was the kind of level playing field discussion. And there was a sense that the framework as it's constructed does not deliver a level playing field across all banks. But one thing which came through very clearly was that insolvency should lead to market exit. So resolution is one thing, insolvency is about exiting the market, and that came out very clearly. We had two messages around DGS. One was some concern about the protection of covered deposits if we were to change the hierarchy of claims. So if we were to go after or to look at the super preference of depositors. This, I think, is based on a misconception, I think. You can change the hierarchy of creditors. You can remove the super preference of covered deposits without, in fact, affecting the protection of the covered depositors themselves. They're never involved in bail-in, so you can do that without affecting it. The other, I think, message on deposit guarantee schemes was a lot of support for EDIS. Actually, the stronger support was for fully fledged EDIS, actually, but a recognition that hybrid could be the first step. And then there were three rather straight messages on the failure or likely to fail part of the process. One, more early intervention, and more early intervention earlier. Support for precautionary recap, good. And then support for the use of DGSs in a more preventive way and rather than just simple paybox. We didn't focus the consultation directly on liquidity and resolution, but I should just take the opportunity to say that, like others, this is a gap in the system, and we do need to address it.
We're coming back to it.
Irrespective of any consultation. Thanks.
Thank you very much. Christian, staying with the CMDI framework review for a moment, what would you say are the concrete steps that are most needed to effectively improve it?
Well, first of all, let me clearly say that I do think that the overall framework and the developments which we have seen were also vital in order to make banks more resilient. And I think we, in particular, as the management of banks, we should look back into 2007, 2008. Many of the reforms which we have seen were the right ones, but put now also banks in a situation where we can really talk about a robust and resilient European banking sector. And now for us at an overriding scheme, it is all about that we have a solid planning basis and we do not have any more dramatic changes, because at the end of the day, a bank's resilience is not only made up by its capital ratio or liquidity ratio. At the end of the day, a bank's resilience is made up by its sustainable profitability. And in this regard, I always want that this kind of mindset and this kind of thought is put into the agenda going forward. And therefore, one of the 4 points I made in my prepared remarks is in particular changes which we have seen now to the Single Resolution Fund, which is really a burden for European banks and which clearly dramatically changes our planning assumptions going forward. And what we think is after achieving a robustness in terms of capital ratios, the average capital ratios of European banks is now 14%. If you look at the liquidity ratios, if you look at TLAC, MREL, which has been achieved in the meantime, I hear Elke König that we should use the current capital markets to build that up. I think we have done that. We are very far advanced. But now it's the time that we use the money and the profitability we have to really give it back to the economy and do that what is most important for Europe, and that is financing the transformation for the next 10 years, and not actually put the money into a tower where it's not used. And that is my big concern, for instance, on the SRF. And we are not even saying, let's stop the payments. Of course, we would like to limit it to the 52 billion. But why can't we think in this situation where we are about more flexible and alternative solutions, like creating a European fund in order to finance the mid-cap corporates? And the money which is otherwise sitting in this tower is actually used for direct financing of the European economy. That is needed. And this is what I wish which would influence the future thinking. Abrupt changes, and like it was for the SRF, is a real pain for the European financial institutions, and that should be avoided.
Hopefully you find it reassuring that our panel is subtitled Evolution and not Revolution.
That's a good first step.
Jan de Carpentier, let's talk a little bit about that SRB blueprint that I mentioned. The SRB has put out its priorities for the CMDI review, so maybe you can tell us a little bit more about those, and particularly what you expect in regard to mid-sized banks. That is to say, those banks that are in fact too large to be permitted to collapse, but not quite big enough to be dealt with at EU level.
Yeah, thank you very much. But first, before I answer your question, I'm tempted, of course, to react on the SRF, because, as you know, I'm responsible for the SRF, so it's a very interesting discussion. But I understand the concerns of the banks, and we're always open. We are rule takers here, but we're always open to discuss. At the same time, I'm also mindful that, in peacetime, it's always good to continue building your funds that you might need in crisis. And I understand the concerns, but on the other hand, I think our perspective is also that an important and strong SRF is of great importance to handle future crisis situations. So I'm coming a bit from a different direction, but it's an interesting discussion. Then on your question, it's difficult to add because a lot has already been said. But from an SRB perspective, I think the CMDI review is extremely important. On EDIS, I can only echo what has already been said, but this is, of course, for us a concern, the lack of progress. So I would indeed also, from our perspective, say, be ambitious, come with a plan, because we need to build this house. We need to build it now and not wait for the next storm to make progress. So that, I think, from that side. But then even going into more details about what would we expect from the CMDI review, where are our biggest concerns, let me just mention two things, and it was already mentioned. It's about this unlevel playing field due to the different national insolvency regimes. This is indeed an issue in crisis, but it is also an issue in planning. So further steps towards harmonization of these insolvency regimes is extremely important, I think, from our perspective, to make resolution even better work and also resolution planning better work. The second thing is the role of DGS, which was also already touched upon. I think what you see now, a DGS could play a role in resolution, but if you look in the factual situation, the DGS is basically not in the money, if you can say it this way. So it cannot really contribute due to the depositor preference. And there, if we would be able to make a change, which then indeed brings this DGS into play, this could play an important role also, for example, in market exit strategies for medium-sized banks. So it could be a crucial element to make progress. At the same time, I'm linking it a bit to the EDIS discussion, if I may, because I think the risk that we see, if at the end of the day, if you end up with national solutions, basically, you might even get into the kind of disintegration instead of integration. So I constantly link that side of the story to progress on EDIS, because at the end of the day, I think a European solution should be found. Thank you.
Thank you very much. I have wonderfully many more questions and unfortunately rather limited time, so I'm going to ask that everybody try to keep their answers as brief as possible. I know that's a really big ask, but unfortunately we are running a little bit late on time due to our technical issues earlier. Sean, I'd like to drill a little bit deeper on the CMDI review, and especially on those issues where you would ask for particular support from national authorities and decision makers.
Let me start by explaining why we describe this as a holistic review, because often the word holistic is used if you don't know what you want to do. So you say you want to take a holistic approach. Yes. We actually do know what we want to do, and it's holistic because it's going to involve all of the legislative pieces in the framework. So it's going to involve the BRD, it's going to involve the SRM regulation, the DGS directive, national solvency frameworks, EDIS, and even the state aid framework. So why is it holistic? Because all of these different parts interact. So my first ask is that people take a holistic view and realize that if we're going to produce something coherent, it's going to have to work across multiple pieces of legislation, which makes this a very complicated process. I think the main problem, and it has been mentioned several times, is with this middle layer of banks. So those banks that are not too big to fail in the sense of the resolution framework, but they are too big to not be handled by something other than judicial liquidation proceedings at national level. So they fall into this sort of, and in fact this is not new, we have been here before. We have always known how to handle big banks. We used to bail them out, now we bail them in. But the middle layer of banks were always problematic, and they remain problematic. And it's because in these middle layer of banks, either because of their size or their business model, there can be a tension between the two objectives of preserving financial stability and protecting taxpayers, because depositors may be involved in the bail-in. And this is where this stress comes. So I think we have to find a way in which we can manage this tension around the bailing in of depositors. And therefore, that's the second thing I ask, is that people focus in on this treatment of depositors in bail-in. Third is, how do we manage it? Well, we think we can manage it by looking at the external funding equation. So this is the funding which comes from the funds that Christian thinks are too big and not usable. But they need to be here because how we will basically square this circle. We have the SRF. We need to look for something outside of the SRF framework, which will also provide external funding. And of course, the obvious candidate are the DGS. Now, in the Commission, not surprisingly, we also have a role here for EDIS as a backstop to those national DGS, at least in the liquidity phase. Because if the funding is not enough in the DGS, today the first recourse is to the state. And that, of course, is back to the doom loop and back to the principle of taxpayer protection. So we think we need to do something here. So again, we would ask for it in looking at this external funding section outside of the resolution framework. This is not to question the rigor of the rules. It's to recognize the fact that you can maximize MREL, but 8% may be beyond some banks, either by their size, their location, because markets are open, but they're not open in all parts of the union. Or their business model makes it difficult for them to sustain large amounts of MREL. So I think we want to do, I know you want to push me on this, but I'll go through what I have to say. The DGS needs to be used preventively as well. So we need to look at this angle, because not all member states can use DGS beyond paybox. So another area to look at is the use of DGS, and to make that consistent across member states, but using a least cost test. One that works, in fact, and it doesn't work so well in the DS directive today. So again, we would look for support around the use of the least cost test. I think if we get all that in place, then it makes sense to look at the extension of the public interest assessment, because then you can start applying this to banks in a way that doesn't make the problem worse rather than better. So I'm going to stop there. I had a few more things to say, but I will,
Sure you do.
I will concede and stop here.
Thank you very much. Let me go back to Harald Weicklein, if I may, because in fact it was the Austrian Council presidency in 2018 that tried to unlock the really thorny debate over EDIS with the introduction of a hybrid model. So how would you rate the progress that has been made since then? And how do you think we can, given what you said earlier about objections of banks like the Sparkassen, which by the way is not limited to Austria, how can we really accomplish this? It's the most loved missing pillar, yet it never seems to get built.
Actually, well, I'm actually going to take a very holistic view, not an Austria, and our role in the presidency was a different one because we tried to unblock a situation that was impossible to unblock, and that's why we introduced the model. Personally, I'm not convinced that a hybrid model can ever be a final solution to banking union. And just in a nutshell, and as I said before, win system for banks, and Sean knows this very well because we talked about this names. I think the only way in the end will be to look at something that actually has proven to work in practice, not try to invent something specifically European here, and just take a benchmark. And the benchmark for me is the FDIC in the US with all its powers. And the rules, of course, there are differences in the legal system, but most of it can actually work in Europe too. What do I mean by that? The one is, of course, one system for all banks when they run into problems, from the largest to smallest. There is, of course, an element of proportionality in there. And on the other hand, the funding, there is actually no reason why we need two funds at the European level, a single resolution fund and a deposit guarantee fund, because the FDIC, as is well known, has only one fund. If we're honest, the single resolution fund fulfills many of the functions that normally a deposit guarantee fund fulfill. It's just that we couldn't make the step back in the day because people had large reservations about deposit insurance. But there is no reason why this should not be the final goal in the end. By the way, that would also provide for nice ways of being able to cut down on contributions, because the FDIC fund now has a coverage level of 1.3% of covered deposits. We have the contributions to the SRF, we have the contributions to the national DGSs. If we have an EDIS, there's another contribution for that. And there's also the bank in the ESM that also costs something. So we actually pay more than Americans if EDIS is introduced, it will be a lot more. The contributions. And at the same time, the coverage level is lower because the FDIC protects up to $250,000, whereas we only protect 100,000 euros. So, to make the system, let's say abuse-proof, and Sean mentioned that too, would be a very strict least cost test, like the FDIC has. And the FDIC's least cost test, by the way, only looks at costs, no indirect costs, because there's a large spectrum of that you can have in there. Direct costs, if you have that, automatically means if you go into a resolution, anything that could be bail-inable should be bail-in. And that's the other side of the equation when you look at the 8%. The 8% are there because we don't do that kind of bail-in. At the moment, we include senior bonds and uncovered deposits, which is by a huge moral hazard. What's the point of having a deposit guarantee scheme if you have to bail out deposits all the time because of the no creditor worst of principle? And the no creditor worst principle is a problem because we have two systems. We have the national insolvency rules that he has to look at when it does a resolution, and the resolutions. In the end, do away with the 8%, bring a very strict principle and bail in everything, including uncovered deposits and bonds.
Thank you.
And then extend this over the whole spectrum. And this could go a long way to reassuring the banks that are afraid of having their contributions used for bailout. One rule, it's been mentioned, the rule of the DGS in resolution. I know,
very briefly, if you would, one sentence.
For that. I'll be very brief on that. If you can prove that the preventive use of DGS contributes to lower costs, I would have no problem with that. But it has to be very, very transparent and clear. It can't, if we have a system where we have preventive measures at the European level, and then some kind of European process that results into some sort of bailout and sparing some, I don't know, hybrid capital holders that should not be spared, then this will not work, and you never get agreement with some countries in Europe. Sorry for being a bit lengthy, but I explain all the details.
Quite all right, but I'm going to start, unfortunately, dropping a few of my wonderful long list of questions here. But let me stay with Edis briefly, if I may, because Spain, of course, has been very adamant about the need for the fledged deposit insurance framework. So how do you think we break this logjam, Paolo Conte? And if I understand Mr. Weicklein, he's perhaps suggesting that one evolution might be to rename the SRF and turn it into something that looks a lot more like the FDIC. By the way, what brings back very nice memories of pre-pandemic times, because I know many of us will remember that once we had the FD head right here live with us in Brussels in the good old days. But anyway, so what do you think about that, and how do you think we can get a breakthrough?
Yes, thank you. I definitely have to agree with the missing piece that is the EDIS, and I have to agreeing with that what we need is a fully fledged moderate European institution where even the SRB would have an important governance to play, no? And it would be a European institution. But I do think that to get there, it's important to also have other rooms, no? And I think picking up as well on what John was saying and Harold earlier, we have to have a consistent, coherent framework to deal with failure of banks across the banking union. Because what is happening right now is that there's a misalignment between decision-making and liabilities. And authorities that are in the day-to-day and that are deciding in resolution whether an entity goes into resolution or not, are that are later facing the cost of insolvency. And we're putting that cost on national funds and even national taxpayers. And that's a misalignment that has to be corrected. And the best way to correct is to actually have a harmonized approach to all banks. And this can be done either by expanding the public interest assessment test in a way that all banks, just by taking deposits, have public interest and therefore go into resolution. And or conversely, as I think at the beginning of this panel, also Harold was going into, a common liquidation regime that is harmonized and that we know is going to follow the same standards and approach throughout the Europe. And I think that's key to building the trust and the confidence necessary to actually achieve a full EDIS and a fully utilized EDIS that should be a European institution. And I think with a lot of advantages and synergies with the SRB and the Single Resolution Fund.
And Jan Reiner de Carpentier, maybe also from you, just a word of response on the debate that we're having here on the SRF. You mentioned it's under your remit, and you did say about it before. But could you drill a little bit deeper in light of what we have been hearing here in the discussion, and perhaps also address the fact that the SRF, despite the fact that some would not appreciate seeing it expanded, remains very small in the event of a crisis. The firepower certainly would be limited.
I think if I would call it very small today, then I get in trouble. So that would not be my assessment. But let me start by saying that enormous progress has been made. And so with the introduction of the backstop, the early introduction next year, basically 2 years earlier than expected, that I think is a major step forward and really adds to the credibility. This doesn't mean that there is then a public backstop. Sounds like access to public funds, but it's a fiscal neutral backstop. So in the medium term, this needs to be repaid by the banks. So this really adds to the credibility. And personally, I really think that the bigger the SRF is, the more credible it is, and therefore also the likelihood that you will use it is also getting smaller. So that I think is a very important element. Is it big enough or not together? I think it is sizable and it is credible, but I also know that scenarios, and it was already explained before, where you indeed see that for big liquidity support, you might still need additional funds. So there a solution needs to be found. The discussion is already pending also for quite long. I don't call it frustrating, but it is pending for long, and we better solve it now. And that would be my main concern. So I would say yes, it's good. It's not too small. It's sizable and I think credible, but a solution for liquidity and resolution needs to be found to avoid a situation where we get in trouble. Thank you.
Paula, can I get you to very briefly weigh in on that? What do you see as feasible and effective potential solutions?
Well, I think that as resolution authorities, as John Brother is saying, there's been remarkable progress, but even hoping for the best, we have to prepare for the worst. Definitely have to prepare for a situation where the day after resolution, the entity doesn't have the confidence of the market, and therefore depositors may still be leaving the institution. They cannot have access to private funding. There may be a lack of collateral, and therefore there's no access to central bank facilities. And there might be a systemic crisis where simply all sources are depleted, even with the enhanced firepower of RF. And I think in that situation, the only real source of limited liquidity would be the central bank. But of course, the central bank needs to have that collateral to be able to grant those funds. No? And I think that's where it's necessary to establish a mechanism that would allow entities the day after resolution to have access to this collateral. And in my view, I think that the role the Commission has adopted recently as a large issuer in the face of a crisis as grave as this pandemic, it can create a window of opportunity to envisage this same role in a future crisis of a banking crisis where there would be the possibility of the Commission actually providing securities or lending guarantees, offering guarantees to a resolved entity the day after resolution in order to access the central bank. And of course, to protect taxpayers' money, even though provision of liquidity provision is low risk, but to protect it, the SRB could stand as the intermediary in between any recouping from the industry any potential losses. And I think that's sort of the mechanic maybe would be the most promising and would take advantage of the fact that as the pandemic has shown, the authorities can act very swiftly and decisively in complicated times, and I think we have to take advantage of that momentum.
Thank you very much. We are coming to the closing moments of our panel, but I want briefly, partly also because we will be addressing this subject in the next panel as well, pick up on some of what you said, Christian Steving, in regard to the global picture that confronts a bank like Deutsche Bank, and certainly for GSIB, like your own. Resolution planning is a global activity that involves subsidiaries and branches in multiple jurisdictions. So could you say just a very brief word, if you would, about what ideas from other jurisdictions you could imagine could be useful for adoption here in Europe?
Well, first of all, I mean, we have always claimed for a single point of entry when it comes to a resolution strategy. And for that, I think key is, in particular, a global bank like Deutsche Bank, that we have a cooperation or a cross-border regulatory cooperation on resolution, which is super important. For us, it is obviously, and that links to the second point, if we don't ensure actually a level playing field of implementing resolution schemes, it is something which makes resolution even harder, complicated, but even more expensive. And in this regard, I would really call for, in this regard, more cooperation across the globe on these items. I think we have gone into a good direction. Also, if I discuss Deutsche Bank point of view, that topic with the US regulator or with EU regulators, I think a lot has gone into the right direction. But I do think, in particular, ensuring a level playing resolution regime with similar parameters, taking costs out of the system, would be for us the most important.
Thank you very much. To you, Sean, picking up on what we heard from Commissioner, she talked about frustration. She also talked about determination and doggedness. But do you see that kind of support, that kind of determination and doggedness out there? Or do you worry that we're risking losing momentum on effective methods for dealing with bank failure, given the fact that a lot of the talk doesn't get walked?
It's a little bit of both, I suppose. I mean, I think you heard from the Commissioner, we remain pretty supportive of any to reform the crisis management framework. And we have our own idea we do it, of course. I think there is a strong consensus among the member states to work in this area. The problem is there's less consensus on exactly how to work in this area. So there are some who feel we should work on all elements together, so we should not pick one element of banking union like crisis management and not the others. Then there are some who think we should just focus uniquely on crisis management, but then within that there are discussions about how we would do it. Some, and they were all on display today, whether we should extend resolution to all banks or create a resolution regime for the smaller banks, or the LT, so the orderly liquidation tool at national levels, have two separate regimes, one for the bigger banks and one for the smaller banks. These are all legitimate positions quite far apart. Not insurmountable means, so let's be clear on that. But I think what's important is that if we have this discussion on CMDI, and I said it's going to be very complex because it covers a lot of issues, a lot of legislation, it probably needs to be in the context of some determination among the member states to make progress on the process as a whole. So to put it in more concrete terms, we need a work plan for the banking union as a whole within which to situate the work we're going to do on crisis management. Because if you do not situate it in such a work plan, there's a risk that we start something that we cannot expect to finish in a reasonable time frame. And we spend the next 4 or 5 years simply creating confusion around the existing framework without really delivering solutions to the problems that we've found. So I think we're very supportive. The Commissioner has indicated she's supportive, she's determined. I've been around a bit longer than the Commissioner. I remain determined. But we will need to start this work in a context where it's clear the member states want to deliver within a reasonable time frame, because I think otherwise we'll simply start a process that confuses rather than clarifies.
Thank you very much. And I've got a bunch of audience questions here, Jan, and in fact, I think we only have time for one, I'm very sorry to say. But let me try to think which one it should be, because they're very interesting indeed. While I consider, perhaps you want to briefly say a word about this one. Is there a role for the resolution community to support the green transition, asks an audience member.
I was a bit waiting for that question. I think that's a very difficult one, to be frank. Of course, we're looking into this as a resolution authority, as an authority, I would say, for ourselves. So that is just to make this very clear how we can contribute. But if you look at our tasks, etc., it is very difficult to see how this exactly would work, and especially as a rule taker. I don't want to kind of speculate about what would potentially be possible to steer us in a certain direction. So I think it's. I don't really see it the angle immediately. That would be my fair answer, and I leave it there.
Thank you very much. And one other question to which all you need to say is yes, probably. The question is this. We see that the SRB is focusing on financial risk and crises leading to bankruptcies. However, currently we see numerous organizations getting close to bankruptcy due to ransomware attacks. Naturally, this would have a massive impact on banks and regulators. It might be helpful for the SRB to organize knowledge sharing sessions about these scenarios, including this in future frameworks. Are there any such plans? And we will pick up on digitalization issues later in one of our other panels.
No, I think this is an extremely important topic, and yes, I think it is on our radar screen in terms of a risk, and I think we're all very concerned about what we see happening at the moment. So that I think is a very valid question, and I can only say yes. I think that as a resolution authority, you cannot just put that risk aside and say, well, this is not something happening. I think it is something that needs to be part of the way you look at planning and making sure that banks can adequately react to that, or if not, that the resolution planning takes these kind of scenarios into account. Because if you talk about continuation of business, etc., there are very specific risks that also require very specific reactions. So, thank you.
Thank you very much. And I would have liked to have others weigh in, but I'm not going to, because unfortunately I need to try to get us back on time. I will simply say many, many thanks to all of you for this very interesting discussion. It was wonderful to have you with us live here on the panel, and thanks as well to Harold Weicklein for joining us from Austria. And ladies and gentlemen, we will move straight onward with our next session, which will drill deeper on some of those cross-border issues that we just touched upon in the last part of this discussion. But first of all, I'd like to go to a keynote from the current Eurogroup President, Irish Minister for Finance, Paschal Donohoe.
Thank you for the opportunity to join the conference remotely today. As President of the Eurogroup, I work closely with Chair of the Single Resolution Board, Elke Köhn, in our efforts to strengthen banking union and deepen our economic. Our cooperation has been especially relevant this year, setting up the common backstop to the Single Resolution Fund and its early introduction in 2022. As SRB Chair, Elke attends biannually to update finance ministers on the activities of SRB, which gives ministers a good sense of developments in our banking system. Well-functioning financial markets within the banking union and capital markets are key to our monetary union. They continue as a shock absorber to support the recovery by providing to households and businesses. The euro is at the forefront of the economic policy response to COVID-19. It will continue in the euro area in identifying, coordinating and implementing the policies that deliver a robust and inclusive and sustainable recovery. The euro area economy is essential for the recovery and to sustainable growth. In responding to COVID-19, demonstrated the unity of purpose. We built consensus on the euro area. We also have a good story to tell in work. The progress achieved over the last decade, the strangulation in the banking sector, has ensured the resilience of the banking and served us well during the pandemic. But simply, compared to the last one, our banking system has proven to be a resilient source of strength, not an underlying source of vulnerability. Combined efforts after the global financial crisis has strengthened the position for forbearance and assistance to their customers in their time of need. Combined with government supports has been vital in protecting millions of European lives. But there is no time for complacency. Over the longer economic recovery, we need to continue our efforts to build a stronger and more one that provides capital and liquidity that in turn fuels the economy. One of the key achievements during my first year in the job of President was the unanimous support of the Eurogroup to proceed with the reform of the ESM, which sets up a common backstop to the Single Resolution Fund and its introduction schedule. While the ESM treaty ratification process member states, including here in Ireland, where I'll be presenting the legislature this time, I remain confident that we will have completed implementation steps in time for entry into force in January of this common backstop to the SRF is one of a number of safety nets which, along with the EIB Pan-European Guarantee Fund, the SURE facility, and the ESM Pandemic Crisis Support Instrument, has built confidence in a recovery. But this resilience, it must be carefully monitored for new or emerging risks. We have to prepare for shocks around the corner. And there are other parts of the Eurogroup work in which consensus has proved elusive. This morning, therefore, I reflect on what we achieved and where I focus my efforts in the coming months to make more progress. So what have we done? Well, with regard to risk reduction and the common backstop, we've continued to reduce risk in the banking sector. This includes a clear trajectory for key indicators such as performing loans in the system, as well as a continual build-up of MREL-related capacity. By 2022, we're aiming to have set up the common backstop to the Single Resolution Fund and other ESM treaty amendments. This will provide a financial safety net resolution in the banking union, which will doubling the firepower capacity of the SRF and the crisis resolution tools of the euro area, and help protect financial stability. These are good changes that will strengthen resilience and crisis resolution capacities of the euro area. Resolution and crisis management, substantial progress has been achieved, solvable by 2023. This is critical. Thank you to the SRB with the national resolution authorities for their valuable work. What remains to be done? Well, we've much more to do on the architecture of the banking union, to better fund recovery, to strengthen stability, to protect taxpayers and depositors, and support European and strategic autonomy. We need a common deposit insurance fund in a banking union. We need to ensure that we continue to work to break the link to sovereigns. We're looking into how we treat sovereign exposure in our... There's obviously more work to be done on cross-border integration. Banks serve all European economies and that they're competitive on the global stage. We need to review some parts of the crisis management framework so that banks of all sizes and business models when in crisis. And we're working to make sure there's consistent treatment and a level playing field across the banking union. The crisis management must preserve financial stability and protect depositors while still limiting moral hazard and minimising recourse to taxpayers. I also want to emphasise the work on liquidity and resolution to address possible shortfalls for all those banks that, despite being recapitalised after resolution, still face a shortage of liquidity. Progress in this strengthened the resolution and crisis management framework in the banking union. The are positive. The shortfall has reduced by 1/3 since the fourth quarter of 2019. We have evidence of a positive market environment, and all banks under of the SRB should meet their 2022 intermediate target according to the latest reports. We look forward to a more report on risk reduction in the European banking systems from our institutions at the Eurogroup in November. This resilience can't be taken for granted. We need to continue our work to ensure consistency of outcomes between resolution and a level playing field when banks exit their markets. We need to do this now. Finally, while not within of Eurogroup, I must flag the implementation of Basel III as in the coming months. The pandemic has shown the importance of ensuring that prudently managed and has sufficient ability to absorb shocks and continue to support me during times of stress. The Basel III finalisation measures will further improve the bank's ability to do so. So, to conclude, a few short words on the Eurogroup, now that I have been its president for over a year. I worked closely with colleagues from all over Europe as we faced the waves of this terrible disease over that year. But our action, I believe, has been strong, it's been supportive, it's been swift and coordinated. I've invested a huge amount of my time and my energy into our Eurogroup meetings to ensure we're spending our time productively, usefully, on matters that are important to the shared future of our currency and which are also politically relevant. To my mind, there are few other areas as politically relevant, as sensitive and as urgent to the future of our monetary union as the stability and capacity of our banking system. So in order to fully embrace the economic recovery from COVID, we need to ensure our financial sector is fit for purpose and that we are prepared for the future. I am determined to make further progress to achieve these goals, and I hope that in your reflection for the rest of the day, you could also consider how best the European banking system can play its part to ensure a solid economic recovery for businesses and for citizens. Thank you.
We are very grateful to Minister Donoghue for speaking with us today. Ladies and gentlemen, we move now into session 2 of our conference. And if you've been with us at prior conferences, you'll be well aware that resolution of cross-border banks remains an ongoing source of controversy. At the core of this home-host debate is concern that host countries in the banking union continue to ring-fence foreign subsidiaries that are operating within their respective jurisdictions, thereby effectively undermining the purpose of the banking union and the goal of fair and orderly resolution. How can we move toward a unified Euro-wide approach to resolution of cross-border banks? That's one question that we want to address in this session, which focuses on achieving a home-host balance. And it is a great pleasure now to introduce our panel. And I can say welcome back to Sasha Mills, Executive Director of the Resolution Directorate of the Bank of England. Great to see you, albeit remotely. I'm also very glad to welcome Claudia Buch, Deputy President of the Deutsche Bundesbank. Very nice to have you with us. We are also glad that David Livingston can join us. He is the CEO EMEA of Citi, and great to have you here as well. Also, Tobias Tröger joins us online. He's Director for the Cluster of Law and Finance at the Leibniz Institute for Financial Research, known by its acronym SAFE. So welcome to you also. And with me live in the room, and that's certainly a pleasure, is Sebastiano Laviola, who is a board member of the Single Resolution Board. So let me start, if I may, with you, Sasha Mills. Just one word to everyone before we begin. We are on a very tight time schedule. I'm sorry to say we're a little bit behind, and our sessions have been compressed in their length. So I would be very, very grateful for brief answers, if you would. So with that said, dear Sasha Mills, the need to continue to serve European clients after Brexit has in fact prompted many financial institutions now to relocate from the UK to the EU, which obviously can have implications for resolution and supervision in the euro area. Has the situation stabilized in the meantime, and what is your perspective?
Thank you, Melinda. It's great to be here. So there's a bit of an echo on my line. So just to start by saying I want to participate in this important conference again and to be discussing home host issues with friends on the panel.
Sasha, we're also experiencing some disturbances. Maybe we should go elsewhere and come back to you. I'm hoping that our technicians can work with you on the sound, because I hear a repeat as well, and I think it must be disturbing to you. Is that all right?
Certainly.
Okay, good. Then I will just skip down a bit further and go to Claudia Buch. You chaired an FSB working group that did an evaluation. Okay, we're having some sound difficulties here as well, it looks like. Hoping you can hear me now, Ms. Buch? Yes, you can. Good. You chaired an FSB working group that did an evaluation of the... are you muted at the moment, Claudia Buch? Yeah, it looks like you are, so that can't be the problem. I'm going to try again. We'll keep working on this. Everybody's familiar by now with these online technical issues. You chaired an FSB working group that did an evaluation of the too big to fail reforms. What are your main findings on the challenges in resolution, particularly when it comes to this crucial issue of home-host relations and ring fencing? You couldn't hear? Aha. Okay. Okay, I'm going to suggest we take a little bit of a break to try to get our technical issues under control, and I deeply apologize to the audience for the difficulties. Wow. Funny, they must have tested all this.
Understanding that technical systems are tested every time.
No, I guess not. Wow.
Me, please?
Yes, I can.
What
should I say? Yeah. So is it working?
Okay. Welcome back, everyone. I'm very, very sorry for the technical issues that we've been experiencing, and I apologize both to the audience and also to our panel. And I'm hearing echo, but I'm just going to talk over it and hope that those on the live stream don't hear it. So I will go now to Sasha Mills with the question about how relocation of European banks out of Britain into the EU is affecting the supervision and also resolution picture. Whether you think also that this relocation situation has stabilized in the meantime? Sasha, you're on mute as far as I can see. No, we're not hearing you. Okay, I'll let them keep working on your sound while I try to go to Claudia Buch again. And that same question I tried to pose to you before, Claudia, that you chaired an SFB working group on an evaluation of the too big to fail reforms. What your main findings were in regard to challenges in resolution, and particularly when it comes to home host and ring fencing issues. Claudia Buch, I'm terribly sorry, but I'm told that our sound still is not repaired. I apologize. I have to interrupt you again. Please forgive me. Ladies and gentlemen, we continue to work on the sound. We hope to be back with you as soon as possible.
it would be nice to be able to work that way again and to see people in person and have the extra. Sebastiano and on the call. You want me to keep talking or?
So, quelle est la solution? Qu'est-ce qu'on fait? Oui, okay. Welcome back, everyone. Third time is hopefully the success. We are very apologetic for the technical difficulties that we've had, and we want to try to do this again. I'm going to go back to Sasha Mills. I think I hardly need to repeat the question at this point, Sasha. Question being relocation of European banks after Brexit, of course, leading now to some new issues in terms of supervision and resolution. Has the situation stabilized in the meantime, and what's your perspective?
Well, thank you again, Melinda. I'm very pleased to be able to actually contribute to this really important conference. Be discussing these important issues because, as you allude to, in everyone's best interests that we are able to operate because we are home and host to really big, globally significant active banks, and it's important that we can supervise them as well as regulate them. So getting that balance right is really quite important. And what I would like to allude to, if I sound interrupted, it's I've got some sound in my ears.
We've got a lot of dropout on your sound.
Right.
Let me, keep trying, and I'll just let you know if it's too hard for us to understand.
Okay. Thank you. And directly to your question then, yes, as expected, some firms have adjusted their business structure across the EU and the UK. That footprint has, but it is stabilised. And I think an important thing to say is that because of the extensive preparations made by the authorities and the private sector, cross-border services have not been interrupted as a result of that, nor has UK or EU's financial stability been affected. And they're asking about what difference does that make to supervision and to resolution. I'll start with the supervision aspect. What is it? So we have an UK as an open financial centre. Our approach branching is driven by our ability to supervise effectively, and that's the same wherever banks are branching from. What does this mean in practice? Supervisors need to be able to see inside the firm, how the branch fits into the group, see and recognise what they see inside the home regulator, and be shown the data that they need for decision making. And in the spirit of incentivizing cooperation, it doesn't include additional capital or liquidity and ring fencing you referred to in the earlier version of the question. That's provided, though, information is free-flowing and that we're confident that liquidity will be free-flowing at the point of view. And that sort of reflects our view about the openness, the efficiency that comes from the openness sharing in the global financial system. Subsidiarization is driven by the level of retail deposit taking, not by critical economic functions like trading and other businesses. Being open this way means that you need to be able to oversee the risks. There are risks, and that's through a combination of internationally agreed high potential standards, close international supervision and resolution cooperation, and a shared assessment of global risk that we're all facing. So I think the next thing to think about is have that play in the resolution agenda. The type of firms we're talking about have a business model which necessitates the use of single point entry resolution strategy. So this is across branches or subsidiaries, and I think that's the key point here. These are whole institutions that we need that are highly integrated, risk management, the business lines, etc. And in times of stress, trying to rip parts of them out will actually create more stability considerations than holding them together, point the single entry strategy. And so what we need to do is be able to understand the regimes, both supervisory and resolution, in that way. And I think it's really important to say that we have really good, close working relationships with our EU colleagues, and recent changes help finish that. We're already really strong relationships that we have. I think will only get stronger, and the type of planning and the sort of event and all the close working relationship touch points that we have with colleagues in the SRB, most directly, and of course, as allies working together in the international fora, FSB, for example, these all kind of the day-to-day and the Cmdi, perhaps we'll talk about later, underpin that ability to look at firms and have confidence that we can resolve in that way. Thank you.
Thank you, Sasha Mills. And I'm hoping your communicating with your EU colleagues isn't beset with as many communication problems as we've had here this morning. I'd like to go to Tobias Tröger now, if I may, because in a recent analysis, your Institute SAFE suggested that significant differences in the structures of banking supervision could well result in regulatory competition between the UK and Eurozone countries. Do you see signs that that's already taking place? And what implications could it have for home-host relations of UK banks that are active in the EU?
Yeah, thanks. So what we did is we looked at certain indicators that give us a more systematic understanding of how these supervisory practices occur between the UK and the EU. And what we realized is that there are differences. We looked, for example, at the calculation of risk weights under the internal ratings-based approach, which is particularly for large banks, important how they calculate the regulatory capital. And there we can see a consistent pattern that at least aggregate weights for German and French large banks directly supervised by the ECB differ systematically from those that Bank of England calculates for comparable banks. So these capital requirements in the UK are significantly lower. But on the other hand, we have no indication whether that's socially optimal or not. A second scenario that we have was the 2021 EBA, ESRB, and Bank of England stress tests, which is the first stress testing scenario that the Bank of England could calculate as an independent authority. It wasn't bound by any EBA, ESRB input, and there we see a similar pattern that there are differences because, for example, with regards to key parameters such as the GDP path and the unemployment rate, the Bank of England generally assumes a deeper dip, but also a faster recovery from the COVID-19 shock. So meaning, on the one hand, they are more rigid, on the other hand, they are more optimistic. So what does that tell us? Essentially, we see that there are different supervisory practices, but we have no indications that the UK is embarking on a reckless, limitless, risk-to-the-bottom type of regulatory competition. And therefore, with regard to home-host relationships, we should be very cautious to impose EU standards of UK entities at all costs through, for example, a very demanding equivalency requirement. But instead, we should actually have some trust in supervisory approaches, although it may differ. And therefore, this trust, and I think this echoes something that Sasha Bill said earlier, has to be built in everyday supervisory cooperation and information sharing, including in particularly resolution planning. And as Sasha also hinted, and maybe a disclaimer in order, I don't get paid by the City of London for saying that, but I think it is an important aspect to capitalize on standing institutional arrangements for exactly this trust-building interagency cooperation and information sharing. And given the terrible feedback that I have, I stop here.
Yeah. We're still facing some real sound issues. I'm just going to try to keep this discussion very abbreviated because we've also lost a lot of time. But I do want to get Claudia Buch to weigh in, if I may. You, as I mentioned earlier, chaired an FSB working group that did an evaluation of the too big to fail reforms. And I wonder if you would share your findings, Claudia Buch, on the remaining challenges in resolution, especially in terms of home issues and ring fencing. I think you're on mute. Are you able to unmute your mic? No?
No.
Yeah, well, we hear you now. We do hear you. Go ahead.
I was told to dial in by phone, so I just for a second and then maybe about the next.
Okay, you sound like you're deep underwater. I think we'll come back to you a little bit later, if we can. I'll try to go to David Livingston now, if I may. And a big concern for host jurisdictions is that a major bank would transfer liquidity and capital to the parent company and in case of a systemic crisis. And I wonder how a multinational GSIB like Citigroup provides assurance to subsidiaries that they would not be left alone or see their resources depleted in times of crisis.
So, Melinda, we operate a single point of entry system of GSIB. We have a framework which is of confidence to jurisdiction. Critical items. One, and this resources both at the but also those...
Mr. Livingston, I hate to say it, but I was hoping you'd be the surprise and your sound might be a little more stable, but in fact, we're losing about half your words. So I'm going to suggest that I go right to the SRB colleague on the panel, Sebastiano, and perhaps we'll see if we can get any repairs done to the sound. So, Sebastiano, to address EU host state concerns about these sorts of issues, the banking package created a very complex new set of rules that, in the end, could wind up actually facilitating ring fencing. The Cmdi review that we were talking about in our last panel does offer an opportunity to address some of these concerns. What modifications to the crisis management framework do you think could generate enough trust among both home and host authorities to make safeguards obsolete?
Thank you. I hope you can hear me. Let me recall, the banking package is a risk reduction package and introduced a number of safeguards. Among these, there were a lot of safeguards introduced also in terms of home host rules, just to provide assurance to the host authorities and host intermediaries that there would have been enough, passage of capital and upwarding of losses in case of a crisis. So there was an increase of the perimeter of internal MREL. But now, what is the problem? So what the home are saying and what the hosts are saying. The home supporters are saying that, for example, what it is not possible today is to have, in case of resolution, but also in the prudential field, cross-border prudential waivers for capital. For liquidity are possible in supervision, but not for capital. And of course, the supporters of a universal approach say that if you had a complete mobility of capital and liquidity, this would, first of all, facilitate the allocation of losses across the group where they are most needed in case of crisis, and will, of course, facilitate the integration and consolidation of the sector, which I think is also needed. Now, the host supporter instead say that, first of all, they do not want, in general, the waiver in most cases because they want preposition, that to say, resources that are at host level because they feel more guaranteed. And they feel more guaranteed because in the absence of prepositions, there could be no incentive for the home parent to provide resources, and there could be problems regarding the insolvency law or no credit also of criterion of resolution with respect to liquidation. Then there is the additional problem. Even though you have prepositioning, then you may have a loss that in very unlikely cases, if the calibration has been well done, could go beyond the preposition resources or beyond the internal MREL. And then there is, a request of insurance from the host authorities, member states, to be provided with resources even in these cases. Now, this is, of course, at the core of the single point of entry model. And we have to be fair here. There has to be some insurance. At the same time, the parental support cannot be unlimited because this doesn't happen in nature in any firm when you have a group. So what is the solution? The solution is that, first of all, at the SRB, we are working hard to further operationalize the single point of entry model, and we want to analyze even more the practices, even at national level, and the potential obstacles to national obstacles to the implementation of the model, to its operationalization. As concerns the extent, essentially, of the financial support, I believe that for the resources that may be needed in the unlikely scenario of the loss going beyond internal MREL, one should start from the so-called intra-group contractual arrangements, which are already in the BRD, in the prudential field, not put in place today because banks have no disincentives, but for which even the ECB, the SSM, has provided interesting views, avenues on which they could be further operationalized in going concern. The problem is in resolution, in going concern. So what we can take from an intra-group support arrangements in going concern to ensure also in going concern that the framework works. And then here we can probably go to address, to give more insurance regarding, for example, some potential national corporate law or insolvency obstacles that might make these arrangements, these guarantees not workable. So to increase, even with statutory safeguards, eventually to enhance this model. And this, I think, would go a long way down through further, operationalize the SPE model, which, by the way, it's the main, as Mr. Sueng said, it's the main model today in place in the banking union banks. Thank you.
Thank you. Thank you very much. And let me see if we can go back to David Livingston, because I would like to pick up on the point that I think you were about to make in regard to single point of entry strategies. Clearly, a key element of making such strategies work is to provide assurance to subsidiaries and ensure that there are credible mechanisms for the transfer of losses from the subsidiary to the parent level. So what are the main challenges that a bank like Citi faces in setting up such mechanisms?
Well, let's take as a given the support arrangements are in single point of entry and with the are the at a time of I think the secret level solution planning, and that not at a parent level, but it's also at a subsidiary level. And so making sure the resources of their own decision making that is in place well as the challenge, of course, there are operations, but the I suppose that can only be that conscious to make sure that there are the resources and at the principle in order to make sure that it operates.
Now we've lost my sound, I guess. No, there it is. It's back. David Livingston, I'm terribly sorry, but we're really getting so much dropout. There's scarcely any sense in asking you to contribute any longer to our discussion. I apologize for that. I will try to go back to Sasha Mills and ask you about pre-positioning, which Sebastiana was just talking about, but I'm well aware that the sound may still not be adequate on your line as well. So there have been some recent discussions about the level of pre-positioning of MREL by host authorities, with concerns raised about the implications for banks' flexibility in a crisis. And I wonder how much trust you think host authorities should have in the availability of so-called unallocated TLAC resources. Is there more work needed here?
Hi, Melinda. I hope you can hear me. So, yeah, I mean, the simple answer to it is yes, more work is needed. It's an area where efforts need to be made to help us feel reassured that unallocated resources will be used in the best interest of an orderly resolution. And I think it's just remembering, going back to the single point of entry issue, the purpose of a resolution of such a large integrated group is really about protecting it so it keeps going and the authorities can fix it afterwards. So that's what we're trying to achieve overall. There's not a win here with home or host winning, because it's a whole, and I think that would be a good concept. So just perhaps if I move on, if we were trying to picture this, trying to rip off a part of a highly integrated group will not only leave it possibly damaged, but trigger the failure of the group, or bring that forward in a way that makes it likely to be orderly, minimise losses, stability consequences, and less likely to prevent tension. So that fragmentation creates more risks for all of us, whether we're home or host. But turning to the particular point about pre-positioning and the trust-based discussion that we're having today, having pre-positioning resources is not a substitute for that trust, and the inter-authorities discussions, all of that is really, really important.
Sasha?
It's a kind of,
the dropout is so extreme again. I think I'm just going to spare you. I really apologize, and I so much wish we could have had the discussion we intended to have. But let me try to go back to Tobias Tröger. I think your sound was a little bit more stable, and ask you one question about branchification. I'm going to give this one last try, because intra-group support arrangements or branchification are often presented as a viable way forward for accommodating concerns of host authorities. Are there other concepts in the academic sphere that you think make sense that have been overlooked?
Well, let me just take a slight step back and question the premise that underpinned your question a little bit, because I think that the two options that you mentioned are in fact ambiguous. Because if we have meaningful, but is somewhat binding and ultimately maybe even enforceable intergroup support arrangement or if you have a branch structure, this may provide indeed host authorities with some assurance that the full balance sheet of the bank is backing the operations domestically. But on the other hand, from the perspective of the home authority, of course, this is partly a problem because that also means that you can import foreign crises into your own system depending on the size of the branch that you're running or the subsidiary that benefits from the intergroup support arrangements. And similarly, also the host authority may face a negative shock that originates in the home economy, despite the fact that its own banks are perfectly sound and viable. And this is, of course, therefore, I would caution that this is somewhat ambiguous to a certain degree. And the alternative of having a subsidiary structure, fully ring-fenced entity with standalone capitalization, obviously impedes some of the benefits that we can have from cross-border banking, and therefore is arguably not a true alternative. So what I want to say as the main takeaway from all this essentially is that the structural arrangements that are there in order to ensure host authorities that the home will take care of this need to be complemented by cooperative arrangements that make sure that people are not able to walk away from what they committed to doing when it really hits the fan. That means when the cross-border banking group actually gets into trouble. Because recall, all these arrangements that you mentioned are there in order to enhance the resilience. But when the failure actually occurs, then they don't help that much anymore. And therefore, it is important that you have cooperation and information sharing in resolution colleges, so that is for the EU, or in crisis management groups, which is for GSIPs, where common decision-making in the resolution mechanism is not available. And therefore, I also think that one key element is that the resolution plans that you draw up at times when everybody is willing to cooperate in a blue sky scenario, these plans need to be more binding than they are at the moment. Because if anybody can just walk away when the crisis occurs from what they agreed to do beforehand, then these arrangements are not very helpful, and they don't trust that it's desperately needed in order to somewhat resolve this home host issue here.
Thank you very much. Claudia Buch, I'm going to try one more time. It looks like you are now on the phone, or at least on headphones. Can you hear me? Can you just give me a nod if you can hear me, Claudia Buch? Looks like she's not hearing me. Claudia Buch? No? Okay. Then I am going to suggest that we leave it there with our online panelists, and I'll just come, if I may, to Sebastiano with a last question, and then we will close this underwater panel of session 2 with our apologies to the panelists and, of course, also to the audience for the technical issues that we've been experiencing. I'm so grateful to Sascha Mills, Claudia Buch, Tobias Tröger, and David Livingston for bearing with us with all of these technical difficulties. And I deeply apologize and hope to see all of you live next year in person in Brussels. So with that, Sebastiano, let me just come back to one last issue and in regard to home host, and it was also mentioned in the keynotes we heard earlier. Clearly, and we heard this a bit from our panelists to the degree that we could understand them, close cooperation and information sharing among resolution authorities are absolutely crucial for addressing these home host issues. So can you tell us a little bit more about what the SRB is doing to foster that kind of cooperation very concretely in practice, and especially with simulation exercises like dry runs?
Well, look, in general, thank
No,
you.
your mic.
Yes, at least this. Thank you. Apologies for colleagues connecting that couldn't speak. But first of all, let me say that we work a lot, and we worked a lot since the inception of the SRB in general on close cooperation and information sharing with our partners within the Banking Union and European Union, and also, I mean, with, in this case, testing also simulations, exercises with other jurisdictions, particularly the UK and the US. US, and Sasha can testify that the exercise that was conducted last year was extremely rich, extremely important for the food for thought provided, and of course, as you highlighted, emphasize that strong cooperation and information sharing, ability to coordinate communication for a banking crisis. This was a big, of course, cross-border banking groups, the simulation exercise, so a GSIB, are important, and also are equally important to understand the difficulties that in each jurisdiction, important jurisdictions, where the group is located, may face, for example, to mobilize collateral. So to understand the legal and practical obstacles that can happen when you have to provide liquidity from other parts of the group to the entity in crisis. Last example is to understand if we speak effectively, we are subject to the same international in the global framework, I mean, to the same international rules, so the FSB, the Basel rules, etc., etc. But there is a different way, maybe, of declining metrics and indicators for capital, liquidity, other types of risks in each jurisdiction. It is important, of course, to understand, so to have a kind of common dictionary, common definitions of the information that are needed in case of crisis. Otherwise, in times of urgency, you spend a lot of time just to understand if a metric is similar to the ones that you have already used. So, I mean, these are important things that in practice may allow to gain time and to build trust. As concerns the exercises in the banking union specifically, or European Union, the SRB has already conducted a number of them. The last one was on a cross-border bank, so a college bank, so with a parent in the banking union and 3 subsidiaries in non-banking union member states. And we wanted to test it what? Essentially the cooperation procedures in a college setting, the joint decisions that you had to take when you have to resolve a bank, so a joint resolution scheme, and also the practicalities, the operationalization of the SPE models. And this goes back a little bit to what I mentioned in my previous intervention, so regarding the potential practical obstacles regarding the flowing, so upwarding of losses and downstreaming of capital, and enforcement of certain mechanism when it is needed. So I believe that in this respect, the simulation exercises are important. We will continue testing that. We have another one planned by the end of this year on a specific aspect, which is the calculation regarding bail-in, I mean, to understand whether everything works as envisaged. And we will continue also the cooperation and the exercises very likely with our peer jurisdictions, that's to say the UK and the US. Thank you very much.
Thank you very, very much. And again, thank you also to our panelists. The Commissioner this morning used the word determination and doggedness to refer to the qualities that we need. And certainly you showed determination and doggedness all to stay with us during all these technical difficulties. So my very warm thanks to our speakers and, of course, to the audience also for those who have been bearing with us during our difficulties. And with that, I will close session 2 and try to move on to session 3. And session 3 drills deeper on the effects of a crisis that has brought one of the most severe economic contractions in recent history, but also catalyzed record levels of recovery and support spending, as we were reminded earlier today, and has seen the banking sector remain relatively resilient, at least thus far. We have an outstanding panel to talk about the impact of the COVID-19 crisis on the banking sector. And we're hoping that this panel is going to work better in terms of technology. I'm just going to jump right in here. Andrea Enria joins us online. He's the chair of the Single Supervisory Mechanism at the European Central Bank. Lovely to see you again, Andrea Enria. Elena Carletti is with us. She's professor of finance at Bocconi University. Welcome to you. Danuta Hübner is a member of the European Parliament and also joins us online. Welcome. Great to have you with us. And finally, it's a pleasure to welcome live with us here in Brussels, Christian Stiefmüller, Senior Research and Advocacy Advisor at Finance Watch. You may join me, please, here on the stage. Sorry, this will be your place here. And also my great pleasure to welcome Bastian Yazbek. He's a board member of the Single Resolution Board, and he will join me here in this seat. And we are still trying to connect with the global head of supervisory and regulatory relations for the Santander Group, Monica Lopez Moniz Gallego, but I think she has not, we have not yet got contact to her. Andrea Enria, you're probably aware we've had a lot of sound difficulties. I'm going to give it a try and see if we can do better this time. So I'll start with you. And banks have done far better over the course of this economic downturn that was spurred by COVID than they did, of course, in the financial crisis. Has that restored public trust in the resilience of the sector? And do you see any risk that the pendulum has swung too far the other way? Andrea Enria, do you hear us? It's looking to me like our panel doesn't hear us. I'll just check again. Professor Carletti. Danuta Hübner, do you hear us? I guess not. Then we'll keep trying with our panelists, and I will go right to Christian Stiefmüller, sorry. In April 2020, Finance Watch raised some concerns about the impact of the COVID-19 pandemic on households and called for urgent responses on the part of both member states and the EU to mitigate over-indebtedness. How satisfied are you with the measures that have been taken to protect not only banks, but also, of course, banks' customers and consumers? You need your microphone.
Thank you, Melinda. Many thanks to the SRB for inviting us to this panel today. Now, back in April 2020, clearly we were very, very sort of exposed to the immediate impact and the immediate shock of the pandemic. I think it is fair to say that the response, in particular the fiscal response on the part of the national, of the member states, and also at the EU level, was swift and was commendable. There was rapid and substantial support for the economy. I should also hasten to say, though, that the very same support also provided welcome support to the asset side of the bank sector, in addition to the capital relief and the liquidity support made available to it. For the individual citizen, clearly, the impact of the pandemic-related standstill had been traumatic. For many, with businesses closed, employees on furlough, incomes lost for months on end. So coming to the issue of household and small business debt, so far what we've seen was an exercise in damage limitation. The moratoria that were put in place, where the EBA guidelines provided welcome clarity and security, public guarantee schemes put in place, the Commission's temporary framework. These were all important, but temporary solutions. What will be critical is the development of non-performing exposures going forward, which is too early to assess at this stage and will largely depend on the path of the recovery, of the way employment takes off and supply chains are restored. Early signs that we have do point to a significant disparity between member states and also between sectors. And it will be at the earliest towards the end of this year, probably, that we have empirical evidence of how the aftermath of the pandemic will affect households and small business. What we need to make sure in the context of non-performing exposures is that the solution are not becoming the next problem. And in particular, that retail and SME customers are not disproportionately affected by solutions like portfolio sales, securitization of NP assets, and the likes. And here, the capacity of the banking sector to sustain the recovery needs to be measured also by its capacity to deal responsibly with the aftermath of the pandemic, and that means supporting viable borrowers. So for the banking sector to really become part of the solution, it must have adequate internal loss absorption capacity, and also external safety nets must be fully funded.
Mm-hmm. Thank you very much. I'm going to go to Bastian. It looks to me like the sound still is not with us and our online panelists, but we'll give it a few more minutes. With the end of the pandemic, hopefully in sight, could you just sum up for us what you see as the most important measures that have been taken by the SRB? It's time.
Thank you, Melina. That is very important question that we're still drawing lessons learned, namely the start of the pandemic and confinement somehow coincided with the introduction of the resolution planning system, which was the first attempt of connecting all the dots in a comprehensive framework that helped not only SRB but also our external stakeholders and interlocutors, and in particular banks, in inputting the resolution framework into everyday's practice and routine. And for that reason, the start of the confinement as a response to the pandemic last year was introduced also with operational relief that the SRB we thought would somehow help to ease the unprecedented events that indeed take place last year. But then we realized that not only us but also banks and our cooperatives, the national resolution authorities, were ready to help and support something that the end coined the notion that banks at that time might not be part of the problem but part of the solution. And that was something that helped us ride the wave throughout the pandemics, and in particular the unfortunate confinement. So this operational relief was something as mundane and as simple as not asking maybe all the data that at once, but or some reports at a time when we thought would be the best. But then we slowly got confident and saw that we were able to fully control and manage the process that is required by us by legal framework. Second, it was because we are locked in a chain when something happens. We were fully front-loading and taking into account the measures that our sister institutions, for example, the SSM was introducing in terms of the capital reliefs and other measures, which of course all affected the way we approached our MREL requirements and our targets. We set up the intermediate targets for MREL in January 22, and then the final target January 2024, and all that was as my third remark and third response to the pandemic environment, in order to better communicate and better share the experience that we were gaining literally on daily, weekly basis. So now, after a year, I would say that a year and a half, I would say that we are more connected in this respect to pretty much whole universe of the banking sector, and we learn how to communicate in a way that, of course, defies experiences we have today with our communication. I would say that the experience in last year was much better and prove us that we can, as a crisis institution, indeed work also in an environment that prevents the physical contact and in-person meetings, and this is something.
Right. I want to come back to that in just a moment, the whole aspect of digital working, because I know the SRB actually has had a very good experience with that. But let me see if I can go now to Andrea Enria. Can you hear me, Andrea Enria? You can hear me. We can't hear you yet. Do you have your mic on mute, possibly? Dear Andrea Enria, is your mic on mute? Because we couldn't hear you just now. No, it's not on mute.
I'm not on mute.
I hear you. Okay, let's give it a try. We were just talking about the situation as we begin to emerge from the pandemic, and certainly banks have done far better over the course of this economic downturn that was spurred by COVID than they did in the financial crisis. So I wonder if you feel that that has restored public trust in the resilience of banks, and whether that trust is in fact justified going forward, or could we even possibly see the pendulum swinging too far the other way?
Thank you. Yeah, indeed, banks in this crisis have played a positive role. I mean, they've, to a large extent, functioned as a channel through which also governments have passed support to households and small businesses and corporates through payments holidays or government guaranteed loans. And the good capital position and liquidity position with which the banks entered the crisis enabled them not to pull the brakes. So usually when there is a shock, an external shock, banks tend to to have a knee-jerk reaction towards risk aversion. They start being more selective and more to tighten their lending standards, and these tends to act in a procyclical way. This time, actually, they kept lending, and they worked more as a shock absorber rather than a shock amplifier. Now, we have to tell ourselves honestly that this is also an important achievement of the post-financial crisis reforms, of the Basel reforms, and we have to keep that. I hear, and you mentioned that also, Melinda, that sometimes there is the perception that the pendulum is swinging too far in the other direction, that banks have shown their resilience, so why should we now move to implement the final Basel package? I think that it's got the opposite. The Basel package has shown its importance, and it is not actually, the objective of the Basel package is not raising the bar, but ensuring a fairer distribution of capital across banks, more consistency, and we need to, bite the bullet and complete this final step of the reforms. Having said that, have we restored fully confidence, trust in the banking sector? Can we be relaxed? I think we need to be very vigilant still. First, we can have asset quality problems materializing once the government support measures are withdrawn. And we start seeing some signs of quality deterioration, especially in forborne loans and loans which showed a significant increase in credit risk. So we need to still be cautious, and also we see that the extraordinary support, both monetary support and budgetary support, public budgetary support, have created, have given great support to the economy, but have also created a sort of environment of search for yield and increased leverage, sometimes increased complexity in financial markets. So we need also to be very alert to these type of risks going forward if we want to retain this feature of trust in the banking sector. Thank you.
Thank you very much. It's wonderful to hear you so clearly. What a novelty. I am going to ask all of our panelists, I'm hoping we'll be able to hear the others as well now, to please try to keep your answers short. Unfortunately, we've lost considerable time due to our technical difficulties today. I'll go to Danuta Hübner, if I may, rapporteur for the European Parliament's Banking Union Annual Report. You also commended sector's resilience in the response to the COVID-19-induced crisis. Would you say this is mainly attributable, this resilience, to the global regulatory policies that were put into place after the financial crisis? Can regulators pat themselves on the back?
Please confirm that you hear me.
Yes.
I hope it is the case. Yes, thank you very much for this conference invitation. Before I respond to your question, let me just say one sentence, because I hope that we are discussing today is a part of a long-term vision that the Union needs financial markets, responding to needs of citizens, but also businesses, and of fit global competition and not captured by national interest, which I think for some of us in the Parliament is very, very important. And I would say that the short answer to your question is that huge progress has been achieved, and Andrea talked about it, and I agree with him, but we are halfway through, I think, still with the reforms, and it is certainly not enough, if you ask me. And also Andrea today in the morning in the Parliament, he told us that it is too early to declare victory. And I also share his view. There is, as usual, in Brussels, we say there is still a lot of things to do. And EU banking sector is, in our perception, not yet perfect in terms of regulatory environment in which it operates and its resilience to risks, but also its integration. And also uncertainty regarding the new risks, what is on the horizon. And also Andrea mentioned this strong bank search for yield, which has also some risks, and there are inflation expectations leading to changes in potentially in assets prices and many others. So we are not in a stable cast in stone environment, and we must remember about it. And let me also say, just being a bit negative, is that all the improvements in protection of depositors and also the reduced risk to financial stability stemming from bank failures, we did not manage to create conditions allowing for breaking, for example, the bank loop, and it continues to haunt us, and it cannot be done, in my view, on the basis of national covering liquidity and also loss sharing models. Also, when you look at prudential treatment of sovereign debt, it still requires a solution. So in this context, I think what is the good news is that the process of reforming the crisis management and deposit insurance framework, which has been launched by the Commission, is absolutely fundamental. And I hope that the ongoing work in the Commission, largely supported with the outcome of public consultations, supported by European Parliament, unfortunately on the member state side, still lacking the will to compromise on many issues, is the reality. But without any doubt, banks have entered the COVID-induced crisis in much better conditions than in the previous crisis. And I would like to say that it was due, if you ask me why, the two functioning pillars of the banking union, state-of-the-art work of supervisors and regulatory institutions, robust regulatory framework, also all the quick fixes were necessary in the crisis that we supported. Also, all those support measures at national level, temporary regulatory supervisory reliefs granted to banks from time to time, all that, I think, increased banks' capacity to continue financing the economy, which was the most important thing. And it is legitimate to say that in spite of relatively low profitability of banks and also competitiveness of European banks, I think this time around banks were not a problem. I agree, they were rather a solution. But there are risks that with full withdrawal of public support measures, not only banking sector, but in the real economy, banks' asset quality can, I know you want me to finish, so I think there are still risks of which we probably will continue to discuss. So there is a strong need to focus on good governance, on credit risk management and control, and also mitigate NPL and build integration and consolidation of the sector. That remains to be extremely important.
Thank you. Thank you so much. Great to hear you as well. Let me go now to Monica Lopez Moniz Gallego. I did introduce you right before you came online. Fortunately, you missed some of the technical difficulties we were having. Let me get your perspective at Banco Santander on two things. First of all, whether you think the crisis could be said to have had positive repercussions in terms of strengthening resilience and resolvability. And secondly, the point that was just made by Danuta Hübner in regard to transitioning out of support measures, whether you see challenges there going forward.
Well, thank you very much, Melinda, for your question. I hope you can hear me properly. And I think that, as you pointed out, every crisis brings opportunities. And given the unprecedented nature of the COVID-19 pandemic, the opportunities to test the group's resilience and draw lessons have indeed been many. So I will start with some lessons acquired from the management of the pandemic from a resilience standpoint. So I do believe that the resilience exhibited by the group throughout these challenging times cannot be understood without the critical role that our crisis management framework has played as a robust governance arrangement to help navigate the crisis at each point in time. Our crisis management framework comprehensively envisages the full spectrum of stages of stress, which ranges from BAU all the way to recovery and resolution. And this lies indeed at the core of our belief that what matters in BAU and early stages of the stress matters for crisis management and not least for resolution. So thanks to this framework, the competent governance bodies adopted adequately and timely decisions on the escalation and de-escalation and on safety, operational, financial, and communication measures. So this is why I want to insist on the criticality of designing a framework that actively combines systematization and flexibility. Another lesson drawn is the instrumental role played by the group special situations function, which is responsible for the implementation of the framework and coordinating the functioning of the crisis management governance bodies. And a further lesson I would highlight is that swift and timely reaction means everything. So indeed, as soon as cases were detected in Asia, we initiated communication with our branches in the region, and we adopted preventive measures early enough to enable remote working of our employees. And also consistent with this approach, our framework was activated in a preventive manner, despite no indicators having been reached in response to our expert judgment for warning potential risk. The purchasing also of equipment and strengthening of connections proved pivotal to facilitate a rapid mass-scale transition towards remote work well before the state of alarm was decreed in Spain. And lastly, on resilience, it goes without saying that in a group such as ours, which hinges in substance on a decentralized management model, coordination during this global crisis has been of utmost importance. Turning now to some insights garnered in terms of resolvability derived from the management of the pandemic, I would like to elaborate on this on the basis of how the group has been addressing the SRB expectations for banks in our multi-year working plan. I will not cover the main dimensions of resolvability for the sake of time, but in particular, I would like to focus on governance, because I think that by means of activating our crisis management governance bodies to effectively help steer the pandemic, we have in fact conducted a large-scale simulation of the governance arrangements underpinning these governance bodies, which would support the resolution authorities were the bank to enter in resolution. Then on loss-absorbing capacity, I would also like to highlight that a relevant milestone in ensuring our preparedness for resolution has been the approval of the bail-in playbook that describes how bail-in will be executed from an operational standpoint. Also on liquidity and finding, the liquidity risk management model of the bank has been enhanced by introducing specific potential key liquidity risks in resolution. And then on separability, I would just highlight that based on the regulatory guidelines from the SRB, and during the last months, we have performed a separability analysis and documented it in our individual playbooks. On the policy side, I would like to emphasize that the model point of entry model, as we have manifested in the past and we still do today, is not sufficiently well known and not sufficiently well recognized in the regulation, particularly regarding our decentralized model consisting of subsidiaries that are based in third countries. Again, having said that, of course, we remain confident that significant progress towards ensuring our resolvability is being achieved by the group, and that this unprecedented experience in the management of the COVID-19 pandemic has in many ways contributed to this worthwhile endeavor. And then moving to your second question, of course, I would like to say during the health crisis, the priority of the bank was to protect the health of our employees and our customers, as well as helping to mitigate its economic and financial impact. As I said, Santander's geographic diversification, together with continuous interaction between our subsidiaries and the corporation, have enabled us to be more resilient in this crisis context. By the end of 2020, the set of customer support measures that the bank had put in place had supported more than 6 million customers in all our geographies, including moratorium loan payments directed at more than 4 million customers, amounting to more than 100 billion euros, and which represented 12% of our lending portfolio at that day. As of today, 92% of that total moratoria has already expired, which implies a payment for performance which is aligned with expectations. Only 7.6 billion euros is currently outstanding, and they are mostly government support programs aimed to help mortgage borrowers. That said, it is worth underlining that governments have avoided a cliff effect with the extension of public aid and its gradual exit. So measures to support households' income and firms that are still available in several countries, which has contained the raise in non-performing loans. And regarding government liquidity programs, I think we also played a crucial role in challenging additional liquidity to firms. Although, once again, there are still firms, specifically SMEs in the most COVID-affected sectors that won't be to serve their financial burden. So it is key a continued support for those viable but very indebted, and for non-viable firms, a seamless exit is probably the best option. As I said, well, I think probably I will leave it here in the benefit of time, and thank you again for the question.
Thank you very much. Let me go now to Professor Carletti and ask you to comment a little bit on the biggest risks that you see as we emerge from the economic crisis associated with the pandemic. And I'll just put two issues out there, but again, with the request for a brief response, if you would. First of all, rising NPLs, rising non-profit loans and non-performing loans, and the risk that they pose. And secondly, the winding down of support measures. There's a big debate around that, isn't there? We heard Keynote earlier saying that, look, this level of fiscal support was unique and it's not going to happen again. On the other hand, I'll say this level of fiscal support represents a paradigm shift away from the austerity model. So I wonder if you would also just comment on that, how you see it and what risks you see associated with that.
Thank you, and thank you for having me in this conference. So let me tackle the first part of your question on NPL. So as we have already heard, the NPL levels are much lower than we expected, but that doesn't mean that solvency challenges are disappearing. There are still moratorium places in the country, and also that is most of the debt is maturing in 2024. So I think it means that we should all still remain very vigilant. So in this sense, what banks should do to address NPL, first, they should accumulate provisions enough. They should have already somehow accumulated provision last year. And importantly, given now that we are in front of this more positive macro scenario, they should keep this provision long enough. So maybe not start releasing too early. And this goes a little bit also to the issue of exit. Second, they should change their credit assessment methodology to incorporate more forward-looking analysis and expert judgment. It's clear that they can rely less than in the past on the existing models. Third, and this is probably the more important and probably the one that we hear a little bit less, they should pay sufficient attention to early detection and be ready to manage troublesome assets at an early stage. Why do I mean this? Because the NPL that will emerge eventually from the COVID-19 crisis will not be mortgage loans as we had in the global financial crisis, but they will mostly be corporate loans, which means that in terms of recovery, banks will have to go through recovery, through restructuring, rather than disposals or recollection in some way, at least more than in the past. And it's important that banks have the internal skills of doing it, and I'm not sure that all banks have it. Also, it's a new way of dealing with NPL. And second, there should also be the framework, the institutional framework around them should be favorable to this, which means institutional context, insolvency procedure, out-of-court procedures, and so on. But all in all, despite all these difficulties, I think it's important that banks focus on early management of troubled assets. And we heard before Andrea say the forborne asset, they're likely to pay. These are the assets in which banks should be more active in dealing with them than in the past. Now, to your second question, I don't think we can say that this is a really sign of paradigm shift of the policies. What I mean is that the global financial crisis was clearly a very different crisis. It was coming from a completely different shock. It was a much more endogenous type of shock due to the behavior of banks in the financial industry. This time is a result, the COVID crisis is a result of a clear exogenous, unexpected, probably temporary, and most importantly, asymmetric shock. So that means that monetary policy could have not have dealt with this by itself, but needed to be complemented by fiscal policy. Because monetary policy cannot really deal with heterogeneities and asymmetries. And also, we live in a world of low interest rate, and therefore the effectiveness of monetary policy is somehow more limited due to the lower. Does it mean a paradigm shift? No, I think this doesn't mean this. But this also does mean that in the future, we will have to release and relax all the borrowing paid and let the sovereign or fiscal policy go unbounded. So it's important in this respect, and very important, the reform that now we are undertaking of the Stability Pact and what come up at the end of this year and next year on this. I think this will really be the sign of where somehow we are going in this apparent shift, but as I said, in my view, this is not a shift. Yes, we were in a different circumstances, and therefore fiscal policy had to be rightly so, and monetary fiscal policy showed important complementarities that probably should not be forgotten in similar circumstances in the future. And let me stop.
Thank you very much for that. And I'd like to go to Andrea Inria, if I may, with a question from the audience, which is whether you think that, in fact, banks profited from the government support measures, and did they also essentially profit proportionately in the sense that in countries where governments provided more support, banks did even better? Question from the audience.
Thank you. I wouldn't say that banks profited. I mean, of course, they profited because the support of the governments to households, SMEs, corporates, of course, reduced the impact on their asset quality. Christian was saying it in the first intervention. I don't think they profited directly. I mean, if you look at the developments of profitability of banks in this period, in these 18 months, let's say, notwithstanding some increase in volumes, the margin effects has been predominant. So basically, the interest margins has squeezed and has reduced as contribution to profitability. The good ability of banks during this period has been more in the area of fees and commissions. And more recently, of course, some reduction impairments with respect to the spike that we had at the beginning of the crisis. So not a direct benefit. But of course, they benefited, and they were also the channel to convey this sort of support to the industry. If you allow me, Melinda, very quickly, a reaction, because I think there is an important connection between what Elena said and what Christian said in his first intervention. So we have been doing a lot of work exactly on this: early detection of asset quality problems, correct classification of customers, prompt signaling of forbearance measures, early unlikely to pay assessments, and early management of arrears. This is very important exactly because you don't want to go into piling up. If you manage early, you pile up the problems, and then you don't generate the problems in the management through only sales and securitization later on that could, let's say, have an impact on the customer. So if you do it early, you restructure and you restore the ability of the customer to pay, then you also reduce the impact on the borrowers and on the final customer. So the work we have done, risk controls on classification, early management, is, in my view, absolutely essential.
And actually, let me ask you, Andrea, if I may, just to follow up also on the question of transitioning out of support measures and whether you at the SSM and the ECB see a risk of so-called cliff effects in the banking sector as support measures are phased out, and whether that could even go so far as to prompt stability or a resolution event.
But, you know, we aim to make their projections, and they project a continuous reduction in the NPL ratio in 21 and 22. So there is, at the moment, there is a perception in the industry that this cliff effect is an issue of the past. To be honest, we are not yet in a position to rule out problems when support measures are withdrawn. I think that more than a generalized cliff effect, it is more likely that we will experience specific issues. So the support measures have been very strong. It is likely that a large part of the customers, SMEs, households, will manage to resume payments once the measures are withdrawn. That's what we are seeing. The countermeasures have already been withdrawn. But there could be some unevenness in the exit. So there could be sectors, lines of business that are not coming back. I mean, we are doing specific deep dives, for instance, on the food and accommodation services sector, on the commercial real estate. I mean, there are specific sectors that might indeed be more structurally affected by the features of this crisis. And so there could be a materialization of credit risk in those areas. So I think we need to be more granular in our analysis of credit risk going forward.
Mm-hmm. Thank you very much. Very briefly, I would like to come back to that topic of digitalization that we just touched on here in Bastian's remarks, but also that was a risk that was asked about Christian Stiefmüller in the first panel that we did today. The fact that, of course, the crisis, the pandemic, fast-forwarded digitalization, also banks, with attendant cyber risks. So can you say a brief word about that, Wood?
With great pleasure. I think it is important clearly digitalization is an infinite spectrum. So I will try to tease out three issues here. First of all, the attractiveness of new digital products and services, whether that's crypto assets or new online-only banks or new brokers. And new categories of investment. That is something that is clearly sort of not solely sort of related to the pandemic, but clearly has been very, very much accelerated because of the pandemic. Why is that? Because clearly people have had to think very, very hard in a low-interest environment about savings in the absence of very often their income, savings and retirement. And clearly also are worried about resurgent inflation. So there are sort of secular trends why people are becoming sort of interested in these sorts of products and services. Now, when we look at digitalization and the role of the retail customer, one phrase that we hear very, very often, and that is hugely problematic, is data is the new oil or gold. We hear that everywhere. And there is one big flaw in here. Oil and gold are commodities. European citizens' personal data, they are not. And I think this is very important. And it is something that, for instance, imbues the open banking approach, where emphasis is being put on data portability instead of data protection. So this is something that we need to, as Europeans, as in the discourse between customers and legislators, we need to keep an eye on. Thirdly, there are very significant systemic issues as well. If we have learned anything about digitalization, is the fact that it creates concentrated outcomes in all kinds of ways. And one relevant examples are the so-called critical service providers for banking, which are addressed through the DORA legislative initiative. So these are new dominant players who could also become single points of failure. And for today's discussion, I think this is very, very important to bear in mind, also as part of the DORA discussion, that First, there needs to be an effective and integrated supervisory architecture that goes beyond the financial sector to look at these providers of digital services. And secondly, the role of these providers also needs to figure prominently in resolvability assessments and in resolution plannings for banks.
Thank you very much. Andrea, with the request for just, I'm sorry, but the briefest of answers, a quick on cyber risk and what kind of a role it's playing in your own work and assessments. Do you think we've come to the point where we need a European agency dedicated to guarding cybersecurity in the financial system?
We do run a cyber incident reporting framework, banks to signal to us the incidents, and there has been a significant increase in incidents in the last 18 months, in the last year. So 54% increase in the incidents, and often using keywords linked to the pandemic and explore also the fact that bank workers were working remotely, of course. So there is an issue which needs to be tackled. Luckily enough, these incidents have not generated a real system-wide disruption for the moment being, but I don't think we should be excessively reassured. I mean, it might well come one big hit in the future. So we need to be very alert in this area. Your question, do we need an agency? Well, I think honestly, DORA is moving in the right direction. That's my impression. National resilience is the key. That's the channel through which these, especially entities that process data that are the counterpart in big outsourcing cloud costs for many of the banks, can be very disruptive for the system as a whole. So we need to be very careful in overseeing these entities. Couldn't go for new authorities. I can say that because the task cannot be assigned to us. So I'm praying for my own, let's say, for my own house here. But I think that existing agencies can very well perform the task. But some new oversight on this type of risks, also for non-bank, also for these, big tech platforms, is well needed.
Thank you very much. And I know Bastian Jesbeck also wanted to pick up briefly on digitalization risks.
Yes, indeed, it is. As much as it is important, it is also true that we do face much less ambitious and I would say mundane risk in this respect, dealing with data and digitalization. But for me personally, I would be very happy if we could set up the management information systems in the banks that would give us the data when we need them. That would give us the data in a structured form. As you know, that there was a great effort even to move from Excel to XBRL protocol in this respect, and this is something that we need to work on. Also taking into account everything what has been said on the very sophisticated risks stemming out of the cyber risk and any other risk. We do have still a lot of operational issues on an everyday basis, and this is something that would hopefully take place also as from the crisis that we hopefully are getting out of.
A few closing questions as we look forward. And I'd go first of all to you, Danuta Hübner, and essentially pick up where we left off with your first remarks. You talked about the fact that EBU remains a work in progress. Obviously, this is also something that we heard from Commissioner Mcginnis earlier today. Do you think that in this phase that we're now in, as we transition out of the COVID-19 crisis. Do you see any hope that this could be an opportunity for accelerating progress on EDIS? We talked about it in the last panel as well, but I'd like to get your take on this in view of the importance that you have assigned it in the past.
You know, of course, we know very well, I think, the history of European Union confirms that you are never prepared to perfectly to the next crisis. Nevertheless, I think we can do a lot to be better prepared and to have better outcome of our policies when the next crisis come. And the issue also here is that on certain elements that belong to the necessary reforms, there are also strong divergences among member states. And also, you can say the same about political groups in parliament, also similar in the banking sector and financial sector. You have also different views on many issues. So moving forward always depends on willingness to compromise. And we don't see much of it in for example, in the Council. You might remember how everything was blocked actually before summer. Plus we had elections. Now we'll have another important election. So the political process is limiting our capacity to act very often, even though we are aware that urgent changes are needed. So let's hope with the Commission work now on this crisis management framework, with the support, I think, coming from all public institutions within the sector, also with the support in the Parliament, we will find enough political will to produce ambitious reform, and also with regard to the banking union and the necessary changes. But I think if I could just say one, because we are looking separately at the banking sector, but we have also to understand that I think resilient banking sector in Europe would be an excellent boost also to the capital market in single union. And I think ensure also the funding for the growth in years to come. We will need a lot of also private investment that requires trust also in public environment. So I think everything is linked to everything else when we are thinking about the reform. This is very, very important. And when you ask me about the EDIs, of course, about the completion of the banking union, I think the best approach would be to bring, to approach the needed reforms in a holistic way, including we need a reform crisis management framework, and we all know that we should move more towards resolution and do more there. We need EDIs. We need also to solve sovereign law. We need also market integration. So all those things just cannot be seen completely separately, and we have to explore all possible ways for a successful fit-for-purpose reform of the entire framework for the financial sector. And we need to relaunch negotiations. I think we cannot afford continuing, I don't know for how many years, 6 or 10, but a lot. No action on EDIs is not an option, I think, definitely today. And even a hybrid EDIs could address many issues, including supporting alternative and preventive measures in resolution. And the essence of EDIs means that incentives of decision-making power at European level can also be aligned with the use of financing tools at national level. So I don't think it's a question. I think finally we have to really understand that it's now or never. So let's hope that by mid of next year, all the proposals from the Commission will be on the table, and there will be enough after French elections, enough or sufficient political will and willingness to move forward, because the next crisis, in spite of whatever Andrea will do and his colleagues in the whole system, might be more difficult for us to handle. So we need to have all the elements in place.
Thank you very much for weighing in on that. In fact, your words very much echoed what we heard earlier from Sean Berrigan when he was talking about the holistic approach. Maybe the optimum in that is that because everything is linked to everything else, if you can crack one big challenge, perhaps everything else starts to fall into place. Anyway, thank you very much for that. Let me go to Monica Lopez Moniz Gallego very briefly, if you would, because we're quite a bit over our end time here. The financial sector in Europe can still be said to be overbanked, and I wonder whether you think we will finally see more mergers and consolidation now as we begin to come out of the pandemic crisis.
Well, I think that banking consolidation can probably improve profitability of banks, although I think we should differentiate in this regard between local measures and Euro cross-border ones. In terms of local measures, there is room to boost profitability via synergies, and many countries probably are still overbanked and can promote local consolidation. And in that regard, countries the likes of Spain have already made an important effort to increase capacities and to promote consolidation. But the reason why I'm focusing on local consolidation is because European cross-border mergers are not really practically feasible today at present, given some limiting factors. For instance, we all know that deposits from one country cannot be used in another. Current banking regulation also penalizes large entities relative to ones. So it should therefore come as no surprise when we hear that European banks are penalized relative to their American peers, which can fully harness real economies by operating with an integrated banking market with common principles and common rules. So as a consequence, the lack of an integrated financial market in Europe undermines scale economies and acts as a strong deterrent for European mergers and acquisitions that would enable efficiency gains and competitiveness. So in my view, to obtain a truly integrated EU financial system, of course, to complete the banking union, as has already been mentioned, it is indispensable to finalize the EDIS. We also need great impetus to draw up a single normative code, not just on insolvency, but on other domains such as consumer protection, anti-money laundering, and data protection, as has already been mentioned. And I also think we need to ramp up efforts to complete the capital markets union, as Danuta was highlighting. It's been years of proposals on the table without relevant developments. And last but not least, I would like to say that we need a diversified pan-European ecosystem with large and small banks and with different business models, because having European global players is key towards ensuring a diverse financial ecosystem. They contribute to financial stability, for example, by ensuring that the system has sufficient capacity to absorb weak players without major disruptions, as we have seen in Spain with Banco Popular. And moreover, these global players have the wherewithal to invest in technology and to effectively compete with other global competitors.
Thank you. Thank you very much. Professor Carletti, from you, please, pre-closing word, if you would, based on experience and lessons learned during the pandemic, what would be your one key recommendation to policymakers going forward?
Well, this is not an easy question, in particular, given that you asked just for one. But let me allow three words: flexibility, coordination, and exit. Flexibility, because this has been a clear success during this crisis. I think we shouldn't forget the importance of being flexible. The second, coordination, I think, as we said before, the mix of fiscal policies, monetary policies, and financial regulation flexibility that we have seen is something that we should certainly have in mind for the future. Lastly, exit, and here I would like to say that we wrote in a recent paper to the European Parliament some criteria that with two colleagues could be followed. These are, again, cooperation and flexibility and judgment, clarity, and maybe one word on this. I think clarity is important on how we will exit from measure, both in terms of modalities and timing, so that both banks and policymakers will be ready for the exit when this will occur. So let me say just one word. For example, take the TLTRO, the third TLTRO. This will end in not far away, so banks need to be ready to start thinking about how to restructure and reform their funding structure. At the moment, they finance themselves at negative rates, so the margin they can make is, yes, a squeeze, but it's relatively simple because they don't have the bound on deposits. Once this will be over, they will have to think about alternative of funding themselves. So this is an example for which clarity on the timing of exit will be important so that everybody will be prepared for it.
Thank you very much. And let me go now to Bastian Yazbek for the real closing word and ask you to tie together the threads in connection with the SRB's recent revision of a key safeguard in resolution, namely the public interest assessment. It requires taking into account both the current macroeconomic and market circumstances, both of which we've been discussing a bit here, when assessing whether resolution is in fact necessary and appropriate. And I wonder if the COVID-19 induced crisis played a role in your decision to revise.
Yes, it did. Of course, the public interest assessment is of course a very relevant framework that gives us a lot of tools to indeed evaluate the importance of the single banking entity in the bigger framework. But however, as I said at the very beginning, about the pendulum has swung too far in one direction, I would say yes. I think that we have to be very careful there. We have to take into account not only the COVID experience, but the forward-looking evolution and unfolding of not only supervisory but also resolution framework. In this respect, I guess that maybe after some time we would come to a bit of a sense also in understanding what the systemic wide effect really is, what the public interest assessment really is, and this would then enable us to probably help us make the justification to something that today, at least in my view, is a bit misplaced, namely adjective European. I do believe that we do have a European compendium of national systems, and we are a bit far from having a true European banking system yet.
Indeed. The closing words very much mirror the opening words that we heard from the Commissioner on that point. Thank you very much, Bastian Jasbeck. Thank you, Christian Stiefmüller, Andrea Enria, Elena Carletti, Monica Moniz-Lopez Gallego, and Danuta Hübner for being with us today and for bearing with us during those initial difficulties with the technology. That brings our session 3 to a close, and I will kindly ask the guests to please take their seats again while I hand over the floor to SRB board member Pedro Machado for closing words.
Thank you, Melinda, and good afternoon, ladies and gentlemen. It is my honor and pleasure to once more give the closing remarks of our SRB annual conference. And I must say it was a joy to be able to organize this hybrid event in a more large setting, first in our own house, in our Brussels headquarters, but also be able to have more speakers than in the previous year. And I think this is a good sign that coming back to a more normal way of life. I would also like to apologize to the panelists and also to the audience for that affected, that severely impaired the discussion during the second panel. But we think that this discussion is a crucial one also. We also announced our commitment to resume that discussion very soon, hopefully with the same panel, because I think there were eventually, for sure, many good contributions to be made on this debate, and I'll become that in a minute. So again, our apologies, and maybe this is a good, really stimulus for next year, for all of us to be here and avoid this kind of glitches. This also puts me in mind of that I think has permeated the discussions throughout the day in the conference, which is this idea of moving forward. Although we cannot set that the pandemic situation is fully under control, the progress made in vaccination seems to feed hope for advance on what has to be done, even when discussing the often challenging topics in the panels. And if we look at the thematic issues that were selected for panels, I think this idea of moving forward is one that in our case revolves around 3 core ideas. The first idea that helps to build the case for moving forward is that we'll focus on the implementation, on implementing bank resolution. Resolution is not only about planning, resolution is also about implementing. And I think this delivery that the chair emphasizing the event today was also, to a certain extent, very much echoed by Commissioner Mcginnis. Implementation is what is expected from us. Our plans must be able to be executed at short notice and in the heat of a bank failing. Our plans must be doable. This is one of the key features of our mission. This was a point discussed or touched in the first panel today, and I think when looked at resolution framework, and a number of the panelists were vocal about this idea. Of course, we have to keep delivering on building resolvability ahead of the key milestone of 23. But getting implementation right underpins such an endeavor in a twofold way. Banks must deliver on the firm expectations we have communicated so as to become resolvable. And, this is the second point, the SRB, together with the NRAs, has to make sure, notably through operational documentation, dry runs, and deep dive exercises, that the plans are implementable. The second idea, or the second core idea of moving forward, was to our dominant model for implementing resolution, the so-called single point of entry, SPE. This resolution strategy seeks to address the home host issue in the banking union. We know that creditors and shareholders will have to bear losses. A bank resolution is not a fairy tale that ends happily ever after. Creditors and shareholders will have to bear losses because otherwise it is the ordinary citizen who has to pay, and this is precisely what our resolution is set up to avoid. But we should also be mindful that when we are implementing resolution under an SPE model, we should not discriminate among subsidiaries, no matter where they are located. We should treat resolution from a group perspective and target the exercise of resolution powers at parent level. As emphatically stressed by our chair in a recent blog post on the matter, and I quote, "The key issue is to ensure the subsidiary is not abandoned, even in cases where the parent itself is ailing." Ensuring the means to achieve this desideratum remains the key challenge for the implementation of the SPE model. A few questions will illustrate well where we should be looking at. First question, is this quest for effective and enforceable contractual arrangements possible in all legal orders? Does the alternative of so-called branchification that was also mentioned here during our discussions this morning, premise on idea of a single legal entity with a single balance sheet, cater adequately for the entering risks stemming from the home deposit guarantee scheme in the absence of AEDs? Or should we consider that the SRB, as the single European resolution authority, has been vested with resolution powers to such extent that it is precisely to prevent the situations where the keys are handed over to the hosts? We think that guaranteeing the sound implementation of SPE might be the best way to unlock excessive prepositioning of resources at subsidiary level and thus live up to the foundation of a true banking union in Europe. As said, we live to the commitment of resuming this debate of the second panel, and for sure we are looking forward to this kind of discussion, and to which for sure will touch upon the questions that I've just mentioned. But talking about delivering and closing gaps brings me to the third core idea, which is the joint regulatory effort that we still have to make to deliver on the completion of the European Banking Union, or in this case, the European Banking Regulation, better said, according to international financial standards, as we emerge from the pandemic. This stands clearly at the heart of the discussions in relation to finalizing the implementation of Basel III post-crisis reforms, which will further strengthen our framework. Whilst we have to recognize that the COVID-19 pandemic created a need for exceptional measures, these reforms remain critically important for addressing shortcomings in the existing framework. And let me be clear about this. The SRB is fully aligned with this joint regulatory effort. Together with the ECB, national supervisors, the EBA and other partners, we share the impetus to move forward on the implementation of the outstanding Basel III reforms, and in particular, how banks risk-weight their assets. Increasing the effectiveness of bank-specific supervisory capital is key for the SRB to determine adequate levels of MREL, which is a cornerstone of resolvability. With this, allow me to come to a close. Today's discussions put me in mind of something that is usually attributable to Johann Wolfgang Goethe. It is, and I quote, "The greatest thing in this world is not so much where we stand as in what direction we are moving." I think it is time to finish what we started and move in a new direction, to make the hope that we have heard from our speakers today into reality and move forward. It is time to move in a direction that will help us deliver together on our shared goal, to achieve full resolvability of banks, promote financial stability, and protect the taxpayer. Thank you, and see you next year.